A very good morning to you. It is Wednesday, the 15th of January, and we've got a brand new PCM, new joiner. The poor guy's only been here 3 days, and I've dragged him into the studio. Please introduce yourself to the world, Will.
Yeah, thank you very much. Yeah, my name's Will McCreary. I started 3 days ago as a PCM, and as I say, been not dragged into this, volunteered to do this.
Oh no,
I actually can't wait. I'm looking forward to it. Yeah, it's all very important in modern times to get in front of the TV and sort of talk about your opinions.
That's right, and we want to introduce you to Gavin Ackers, Monkey Man, Carlo, Carl Wolf, Funky Gibbon. We've got a kind of monkey theme going on because Monkey Man was our first ever viewer. So some of the viewers have decided to take similar names, such as Gorilla Girl, Funky Gibbon.
Yeah.
Exactly, in tribute to the good man himself. So good morning to you all. I'm sure that you all welcome Will to the programme. I do hear that he makes very good hummus.
Yes, that you do have a good inside knowledge there.
I do. We have managed to actually steal Will across from Saxo Bank. So he's made the upgrade.
Yeah.
Dan Squires is actually a viewer of the show.
Hello, Dan. Sorry about causing the inconvenience, but
I mean, where else do you think Saxo get their ideas in the morning from other than Box of the Show?
Exactly. Yeah.
So yeah, some very interesting stories. So after university at Newcastle, Will did set up his own DJing company.
Yeah, again, very true. Well, you've got my CV somewhere. HR, thank you.
And how was that? That sounded like it was a...
Yeah, it was good. Yeah. So did it at Newcastle University, and then also a bit outside in London. It was a sort of a niche. It was a bit niche, sort of a liquid drum and bass night, and it went well. Just I thought maybe it's time to grow up and sort of start earning some decent money.
Well, I was the same. I used to run round in a circle, jumping over bits of wood. Some people call it hurdling. But Gavin Ackers, you've been mentioning Linford, Colin Jackson, Sally Gunnell, Regis Akabusi. Now, that was a team. That was, what, the 1993 Stuttgart team, I think, there. I once put Linford Christie's blocks in place for him.
Okay,
and then carried his kit away.
That's peaking right there.
That was the claim to fame.
Yeah, I love that.
Yeah, up in Scotland in Kelvin Hall in Glasgow. So I was 25-year-old, so that makes it a bit weird, but no, not really. Yeah, that was my. I think I was 13 or 14, and yeah, got to meet all the great athletes at the time. How old are you, Will?
30.
30, good age.
Yeah.
Good age. I just had my 32nd birthday the other day as well. Yeah. What are they shouting lies in my ears? One thing I did think is, so there's complaints out there, I didn't let people know that it was going to be my birthday. We don't know when your guy's birthday is. You could be sitting at home and you could be, celebrating Monkey Man. We need to know when your birthday is. But if you ever have your birthday, in the morning, please just put up, nobody wants to say, oh, it's my birthday. Put up a cake or something, or a celebration, so at least we know we can give you a shout out. Happy birthday. Now, it's Rachel Reeves' birthday today because she's got the CPI number she was waiting for. So we're coming on to that shortly. What else have we got coming up on today's show, Will?
Well, at 8:40, we're going to look at the psychology of trading with Izar Bhattacharjee. Sorry about the pronunciation there. That was a tough one early on. And then at 8:58 a.m., all sessions opening bell with Martin Harris, and then lastly on the list, 9:40 a.m. 2025 Outlook with JJ Kinahan.
Now, those of you that haven't seen JJ's name on the schedule before, well, you're in for a treat. He is the CEO of IG North America and has been at tastytrade since before IG and tastytrade had their wedding a few years ago. So that's going to be really interesting. He's worked with the guy Sosnoff and Bat and everybody across at tastytrade for a number of years. Also has the background on the Chicago board as well. So tune in for that at 9:40. For the outlook of the year. Well, we're going to go into some overnight action. Right, so yes, you used to try and sell hummus to clients. Yeah. Is that right? And hats?
Yeah, so definitely the hummus. The hat was the hat idea was always just a sort of brief sort of experiment. But the hummus, yes, not so much declines. But I used to run a sort of market stall at the weekend and festivals for a good sort of 2 years after COVID.
But you made it yourself?
Made it itself, and it was like inspired by like the ice cream cone idea. So we put it in like sort of Greek flatbread shell, and then I would have you'd have your different scoops of hummus, and
this is brilliant.
Yeah,
the PCM desk out there getting
I know
very
exactly.
excited.
I know, yeah.
We're sorted PCM pita breads and hummus weekly. It's got to be a weekly thing. We already get free lunches on a Monday, so
there you go, exactly. So we'll do a different one.
Yeah, we have to get you
people on a Wednesday, so we'll do it on a Wednesday.
Now, let's look at those inflation numbers then. Yes, there's a huge sigh of relief there. You can see the core came in at 3.2 versus 3.4 expected. We also had a core reading month on month, 0.3 against 0.5. So it's not just under, it's well under. And thank goodness for that. Otherwise, oof, that could have been a mess, couldn't it?
Yeah, exactly. I mean, yeah, she's definitely breathing a sigh of relief. They definitely need that Labour Party after all these little things that are going on right now, especially with the woman who's just been resigned. So just more about, I can't remember her name, sorry, but more bad news for Labour.
It's Sadiq, isn't it? Because
yeah, exactly,
I actually thought it was Sadiq Khan.
Yeah, that's what I heard originally on a podcast. I was like, oh, God.
At last.
Yeah. But they definitely need some good news, and this is 100% exactly what they wanted. And hopefully it means she can sort of, as I say, start doing a bit more sort of her sort of fiscal policy and seeing where it leads.
And yeah, getting back to actually getting things done rather than fighting fires.
Exactly, yes, yeah.
How has that affected the futures this morning? Let's take a look at where we are. It was a horrible session in the US yesterday. It was, I got topped and tailed. I know Sosnoff got topped and tailed as well. But you're looking at FTSE 100 there, up 50 basis points.
There you go.
I cannot remember seeing the FTSE outperforming the rest of all of Europe and US futures. That is fantastic.
Strong. Yeah, exactly. That's what we want to see, for sure.
Let's take you down to the pound. The pound also holding 122, which is interesting because lower inflation means the Bank of England's frees them up to move on interest rates.
Yeah.
But the pound's holding the level.
Yeah. It's a tough one to explain. But yeah, we'll see what sort of happens.
I get, maybe the pound's been moving with the gilts. Gilts kind of melting away as they've done.
Yeah.
People worrying about sterling there. So, yeah, we live another day.
Yeah, exactly.
Or do we live until 1:30 this afternoon? That's the thing. As you rightly pointed out, big day, isn't it?
Yeah, the US CPI as well, which forecasters saying it's going to sort of continue to rise sort of for the 5 months sort of consecutive period. So we'll see what happens there, and also some sort of big US bank results as well to match that, which they'll be looking at the CPI as well.
No, that's another. So you can come back. It's the start of earnings season. That's what we forgot. So we get I think it's 3 banks. Goldman's are today, aren't they? Yeah. So 3 banks. So more about that coming up later. But let's take a look at the front page of the newspapers. What is the Financial Times giving us today? Well, Katie Martin telling you that the bond vigilantes are overexcited again. So that's taking you through a bit of sort of just going over what happened with Liz Truss, and it's different this time. Bond vigilantes can smell blood, enlivened by a shakeout in the government bond market. But it's an interesting article, but her summary to the end is that they can just all calm down. And as Rachel Reeves said in Parliament yesterday, get real. So yeah, that was the headline story is a little bit misleading. Emerging market stocks slide on Trump tariff threats. It's not actually talking about overnight. Last night. it's a more general piece about since October.
Yeah.
You've had, the EM index tracking nearly $7.6 trillion in stocks.
Yeah, well, it's all about the protectionist sort of mindset of Trump, where he wants the US to grow. I think he phrased it as MAGA economics or something like that, where.
Yeah, MAGAnomics?
MAGAnomics, yes, exactly. Where it's all about, just purely about the US, and as a result, as I say, investors will be looking in the US rather than emerging markets, which are potentially going to be sort of tariffed for imports into the US and exports out. Yeah.
It's going to be an interesting first 100 days, isn't it?
Yeah, exactly. And I think the economy in general is just completely just waiting for that moment. It's a market which is sort of going sideways at the moment. Everyone is looking at these small little details about sort of the PPI market will move a little bit and then it'll relax, it'll ease, and then the CPI, and then sort of financial banks results. There's small little data which people are just sort of trying to get some sort of little scalps on, but then everything just sort of calms down a little bit. And I think until Trump, as I say, does this sort of 100 days, I imagine we'll sort of continue seeing that sort of steadiness and but volatile, but sort of steady market.
Something tells me he's not going to wait for the 100th day.
No, that's true, exactly. It's going to come in the bag for sure, 100%. But yeah, it's all very exciting to see what's going to happen, whether it be whether you're a Trump fan or not. Yeah.
Now, I thought it's a little bit brave of the CMA in the UK, because if we look at the front page of the Times today, Google to be investigated by UK's competition watchdog. This is the kind of thing that's going to piss Trump off, isn't it? But they've announced this, 5 days before his inauguration. So, competition regulator used its new powers to launch an investigation into Google. I'm not saying it's wrong.
Yeah.
It's definitely the right thing to do.
Yeah, exactly.
Timing is interesting.
Yeah, I completely agree. And I think, but I do think with Trump, it's a tough one. I think you've got to sort of stand up to him a little bit. You can't sort of bend the knee too much, otherwise he would sort of, completely
walk all over you.
Yeah, walk all over you, exactly.
Yeah.
So I do like it a little bit where the UK is trying to be a bit sort of forceful and trying to sort of stamp our mark on we're saying that it's our country, we're going to govern it how we want to. But I do agree. I think Trump it could be interesting to see how he sort of reacts to that.
Yeah. Now, who was it that you initially interviewed with? Was it Pete Ward?
Yeah, on the second stage. But yeah, Pete Ward. I did it with Sarah, Chris De La Vega, and also Sam.
Brilliant.
Yeah.
So all friends of the show, but Pete Ward in particular. This next story is one in for him. Eli Lilly and their weight loss drug. The shares of Eli Lilly tumbled as much as 8% on Tuesday. I think it finished down 7%. And that was because the company forecast weaker than expected fourth quarter sales of the weight loss drug Zepbound. But I must say, CNBC had the CEO on yesterday, and it was about a 15-minute interview.
Yeah.
And it's a great watch. Anybody who would be thinking about investing in Eli Lilly or has done, then it really takes you through the whole story. And it's interesting. I must say, I went straight on to the Tasty platform, and let me show you what I did there. So the stock's trading at 745. First of all, I sold a March put at the 650 level, and got a nice uptick there. Sold that for 13, and it's now down. I think the vol must have come out of it.
Yeah.
That it had that. But then I went on and got a bit more brave, Will. And I put on a June, selling the 550 put, and then buying an 840, 980 in 1x2.
Nice.
So that's that all came to 34 minus 2014. That came to about $7. So $140 of upside, and it's going to cost me $7 out to June. So yeah, quite happy with that one.
Yeah, definitely. Well, I mean, that's the beauty of options. You can take risk, can't you?
And have you had to go on the Tasty platform yet? I mean,
yeah, I did.
3 days in.
Yeah,
oh, you have?
Yeah. No, I think it's great. As I said, I came from Saxo, so they do options, so I'm familiar with them, and really enjoyed the Tasty platform, and it's very sort of user friendly, and yeah, it's easy to use. Yeah.
Good stuff. Right. So yeah, Eli Lilly we have covered. Is there what was the stock results we had this morning?
Currys is the one.
Good old Currys. Are you a Currys fan?
I've been before for sure. Yeah.
Yeah, it goes with the hummus well. Oh, sorry, Currys.
Yeah.
Right, not the old Indian. Let's see, we get Currys up and get the trading statement there. But yeah, I must admit they've really sorted themselves out. Because you would have thought it would be one that would sort of die off with online.
Yeah.
But they've got themselves into that great position where you go into store and they're fantastic customer service.
Yeah,
and I now order stuff off Currys' website.
Yeah, nice. Yeah, it's great.
Yeah, because I think they deserve it. I think it's...
No, exactly.
So let's look at the outlook there. Raised its annual profit outlook after reporting a 2% rise in underlying sales for Christmas trading. They are talking about adjusted PBT 145 to 155.
Nice.
And that's analysts' average forecast is 140. So at last, somebody on the UK high street.
Yeah, exactly. Yeah, for sure. And I think you guys were talking about retail. I think you talked about Lululemon yesterday, weren't you? And I do think retail will have a bit of a sort of kick on this year. I think hopefully, especially on the high street, because we all want to see the high street thriving.
Yeah. And whereabout in London do you live, Will?
I live in Dalston, so yeah, East London right now. Yeah, so yeah, all good.
And how's that high street?
It's manic, very, very crazy, but
right.
There's still some shops going, and yeah, it's got a great buzz around it, and that's what makes a good area, a good buzz around the area.
Yeah, I must admit, so I went back to Perth at Christmas time, up in Scotland, and you go down the high street, and it's charity shop, phone shop, empty shop.
Yeah.
And the Debenhams closed down. Debenhams was like the centerpiece of the high street. And it's really sad. I think anywhere north of kind of Northampton, you walk down a high streat and, not counting Manchester. And
yeah.
I guess, Newcastle's probably changed since 10 years ago.
No, exactly. I went up there actually earlier in the summer, and it's definitely changing. You're getting more of these sort of, getting rid of the sort of bigger names, and I guess you're bringing in sort of like maybe sort of, could be going to housing, but there are some more sort of boutique coffee places, which is quite nice. But I just say that that the housing is coming in, and it's definitely losing its sort of buzz around the street for sure. But then
we all use Amazon.
Yeah, so, exactly. Yeah.
That's what my mum says. She says, you can't argue against the high street in Perth because you've just ordered 3 things from Amazon.
It's tough. It's just Amazon is just so good and quick. It's hard to argue with, isn't it?
Yeah, and they've just ordered 150 electric trucks. So you will now see on the motorways around the UK, you're going to see these huge electric juggernauts. There's only something like 600 on the road already.
Wow.
And they've ordered 150.
Amazing. Okay, interesting. That'd be so great to see.
Yeah. Not sure how the drivers feel, because you have to wait an hour for it to charge in a motorway station.
Oh, really? Yeah. That is the issue with these EV cars, aren't they? They just sort of take a bit more time to charge.
Yeah. Never mind a truck.
Yeah. Exactly.
Good stuff. So Monkey Man. So yeah, definitely listen to that Eli Lilly interview with the CEO. It was really interesting. And then also Lululemon was small down yesterday, so I put on a position on that one as well, selling a strangle in Lululemon. Much of a gym man?
Yeah, especially in January. I'm very sort of early year heavy, and then sort of summer sort of ease off.
You got the summer body there.
I never ever had that, but just once it gets a bit nicer weather, I'll probably stop doing a little bit more.
Welcome back to Luke Moore as well. He just stepped in the office after 2 weeks now. Was it in the Maldives or was it?
Mauritius, I think I overheard. Yeah.
That's right, same thing.
Exactly. Both beautiful.
Right, now we've got some pre-markets coming in. So Curry's looking up 2% pre-market. We've got there's an interesting article in the FT actually about BP. Let me see if I can quickly find that because they're trying. Yeah, here it is. One of the spotlight pieces. So pressure mounting on the BP chief as investor patience wanes, and it's yet another one of these articles that is pointing out the massive underperformance of BP against Exxon since Deepwater Horizon.
Yeah.
I didn't know they're still paying.
Still what, sorry?
They're still paying the fine for Deepwater Horizon.
Oh, wow. Yeah. I didn't realize either.
So there's a good graph here, actually. Yeah, there we go. Wonderful graph, actually, to see the value destruction in BP since that Deepwater Horizon incident, dropping from about $250 billion market cap down to where it is now at only 90.
Wow, that's pretty staggering, isn't it?
Exxon Mobil has outperformed. It's now worth 6 times BP. Wow. I mean, you no wonder people are talking about M&A.
Yeah. No. Exactly. Yeah.
I didn't realise it was quite that much. But yeah, so Hawkins lost. Poor guy. He was in for an operation last week, and so they've had to move the investor day. And then you know he'll wake up this morning and he'll be tuning into the show, obviously. But next thing they're calling for your job when you're laying at home.
Yeah, that's tough
for an operation. Right, AP asking us on coffee, cocoa, and sugar. So I must admit I don't know what they did yesterday. So let's have a quick look at. Oh wow, cocoa's back up to those highs. Wow. Let me get that up properly. Look at that. That's that puts it in better. Have you traded this or you?
I haven't. I have had clients that have traded it, so I'm sort of familiar of why it's rising. So obviously with global warming and stuff like that, and less places, it's harder to sort of make cocoa around the world. But so I think it's a pretty good idea to sort of put some sort of time and thought into it for sure.
And of course, last Easter we saw Dan Squires in his own video, and that was what inspired me to get into social media.
Yeah. Oh, really?
Yeah. If somebody can do it that bad, then there's a lot of upside.
Yeah. Exactly.
I'm definitely sending this to Dan today. Good stuff. Right. More pre-markets. So we also had a move in. There was a placing in Haleon. So Pfizer are selling their stake in Haleon because, of course, 7.7% stake is pretty meaty.
Yeah.
So Haleon looking down 2% on the open there. That's going to be an interesting one to watch, actually. Let's see how Haleon's done since it came to market.
Yeah.
Actually better than I thought.
No, exactly. Yeah, it seems to be doing all right. And obviously that big stake would drop the price. But actually, apart from that, it's moving in a sort of good direction. So
I must admit that I was a very proud GSK owner, still am. And I got some of these. And I think I was part of the group that's just got rid of it down here because I didn't really understand the valuation. And as it looks like everybody's done.
Yeah.
And then, we've seen it go from £2.50 to £3.67. So, interesting one. Right, we are going to go to a quick break.
Sure.
We'll have a few minutes, grab a coffee, get the kettle on at home, and we'll see you in 2 minutes for the opening bell.
Welcome to the exciting world of options trading. If you're looking to add a new dimension to your trading strategy, you're in the right place. Options trading offers unique benefits that can elevate your investing game. With options, you can protect your portfolio against market downturns, essentially creating an insurance policy for your investments. Now, what sets us apart is our commitment to your success. We provide extensive educational content to help you understand options trading inside and out. And with our 24-hour servicing, support is always just a call away. But that's not all. Options also allow you to generate income from your existing positions. Strategies like covered calls let you profit even when your stocks aren't making big moves. Options also shine when the market isn't following a clear direction, whether prices are rising, falling, or staying flat. There's always an option strategy you can use to potentially benefit. Now, we offer two ways to trade options: listed options for US shares, ETFs and futures, and over-the-counter options through spread bets and CFDs. Both types give you the ability to take various market positions. So, ready to explore the potential of options trading? Well, open an account today and take your first steps into this dynamic market. Remember, while options trading can be rewarding, it comes with risks. Always trade within your means and never risk more than you can afford to lose.
No, I don't know anything on it. Cool, yeah.
Right, good stuff. We've just been running Will through the rules for ringing the opening bell. So it's a big moment.
Pressure, yeah.
I mean, London stocks are not going to open if you get this wrong.
Yeah.
So one day, people, one day we shall be at the London Stock Exchange ringing that bell for you. That would be great, wouldn't it? Bringing the show live to you from the LSE. Let's put the calls in and see what we can do there. Right, how's everybody this morning? Andrew McKelvey, how did you get on yesterday? That was a decent bounce in JD. It looked pretty ugly, down 10% on the open.
Yeah.
And it managed to crawl its way back up. I think it was only down 5 at the end.
5 in the end, yeah. That's a good recovery for sure.
Now, Andrew's talking about Sarabi Gold.
I've heard of Sarabi Gold, yeah.
Yeah, remind me what... did this used to be called something else?
I've known about it for a year or so. I read about it on sort of the Investor Chronicle or something like that. And wow, I wish I got in on it.
What a year!
Yeah.
Jeez. Andrew, thanks for telling us about this one a year ago. So yeah, gold in general, it is my biggest long of the year in options terms. Very happy to, I'm short puts about 6% lower, I think, because there's always that volatility, isn't there?
Exactly, yeah, for sure.
And something will happen, rates will tighten or something like that, and you'll see a shank down. But I do think with what we potentially have coming up ahead, Goldman say that gold's going to 3,000.
Yeah, exactly.
It's hard to argue with.
Yeah, definitely. I definitely think you should have some sort of exposure in gold for sure.
Yeah,
just diversify the portfolio as well.
Exactly.
Yeah.
In the old, is there a Will ISA, Will McCreary?
Yeah, there is. Yeah. Gold's in there in terms of a stock. I'm on a company called Pan African Resources,
right?
Which was actually was sort of spoken to me by a couple of people and got on that, and I've got a good sort of return on that, and hopefully it's going to carry on going up.
Yeah,
but, that's my sort of gold exposure.
I must admit, looking at my ISA at the moment, it's copper, Vodafone, SSE. It was actually short S&P 500. I had the inverse.
I had
ETF.
that for a little bit as well.
Yeah. But I did cover that on Friday, actually, at the close on Friday. So we got 30 seconds to the opening bell. What are we looking at? We're going to look at today just generally the FTSE. The FTSE seeing that big relief. We're going to have a look at gilts. You don't have to put it up yet, sorry, mate. We're going to be looking at gilts and generally how the retailers react to an actual upgrading guidance for once.
Yeah.
Kingfisher, I would think, would be relieved at that because normally you get a B&Q next to Currys in these big parks.
Yeah.
Right, if you want to grab that bell, Will, all ready for you to ring in 2 seconds. There it is.
Yeah.
Hey, he's a natural. Absolute natural. Right, good. And the stocks have opened. You'll be happy to hear.
Fantastic.
You'll be,
Yeah.
be relieved. So what are we going to say? Ubisoft up 4%. There's obviously something going on there relative to that bid. We'll check that in a second once we get more. So Land Security is up 2.3%. The banks, they're getting back into the banks. Barclays, that's one I wanted to buy on the dip. That's really frustrating. Numis had the IR in from Barclays last week, and reading the email, I've got to admit, it sounded like they've really got a strategy there in place.
Interesting.
So yeah, Barclays is one I'm looking to buy on weakness. Persimmon, following on from yesterday. So let's see, what else are you seeing there, Will?
So what am I seeing on there? Well, I'm seeing delivery, and that's good. That's good for me. I was unfortunately one of those. My first ever trade was delivery. I got it on the IPO, and obviously it absolutely tanked ever since.
It's been raised to outperform today at BNP Exam to a 180 target.
I'm not sure it's ever going to get to 350 where I got it at, but
You know they're in the same building actually.
Yeah, of course they are. Yeah. I might sort of kick someone's ass and get them working harder.
Right, the utilities really seeing some relief in gilts then. SSE up 1.7, National Grid up 1.8, and we're going further down, Centrica up 1.6. Kingfisher seeing some relief on the back of Currys, up 1.5%. Now, where's our mighty Vodafone? Vodafone, 68.40. Gavin Acker's asking if Vodafone has seen a double bottom, and that could well be it, around that 66, low 66s. Vodafone up, 1.7%. Curry's not open, so Curry's looking to open up more than 5%.
Okay.
Right, Will, what about in Europe there? What are you seeing on the European names?
So what are we looking at? In terms of banks, Deutsche Bank is, it's opening up at 0.74, so clearly it tends to be a bit of a sort of shift for banks right now. Same as SocGen opening positive as well. And obviously that all leads on to the US banks and their results today. So interesting sector to be looking at for sure.
Andrew McKever, you'll be happy to see JD Sports continuing its recovery, up 1.2%, 91.30 from trading 85 pence yesterday. That's quite a decent recovery. Right, any losers? There's only two or three losers in the FTSE. That is really nice to see. Flutter after a strong day yesterday. IAG, not much going on there, and yeah, pretty much unchanged.
Yeah, strong.
So let's see what gilts are doing, because I must admit I bought oh my goodness, they're absolutely motoring. Good stuff. Right, we're seeing gilts back up to the 90 level. All right, it's not a huge move, is it, compared to what they've lost?
No, exactly.
But we're certainly back. How many days is that? 1, 2, 3. We're back to where we were last Wednesday when the panic kind of started.
Exactly, yeah, for sure. And I think we'll start seeing sort of long-term investors hold a sort of defensive position in sort of bonds right now, just to sort of, as I say, get some returns on what is a pretty sort of steady market at the moment.
Yeah. Well, let's have a look at what those gilts are getting you now. See if we've updated that one. Yeah, UK government gilts, 5.38 on the 30-year, the 4.8% on the 10-year. Interesting, the head of platform from Hargreaves Lansdown was on CNBC this morning, and she was saying that it's remarkable the number of clients that they're seeing buying gilts on the platform.
Really?
In their ISAs, in their SIPs.
Interesting.
Because, yeah, do you want exposure to the S&P 500 up 45% in 2 years, or do you want a guaranteed 4.8%?
Yeah, no, exactly, for sure. And it's interesting because I always think of people buying bonds as people who are sort of very financially literate. So it's very interesting to see that more people are doing it. Obviously, I think that I definitely felt that over the last couple of years, is the client base is becoming way more financially literate.
Yeah.
So yeah, just another example of that.
It is. It's thanks to some great people on social media that are, bringing that financial literacy to the world. Such as Michael Taylor, Finfluencer of the Year 2024. Got on the podium, 3rd place. Right, so we are, it's a long way till we see even the start of December. Gilt's sitting at 96 the start of December. So yeah, there is a bit of volatility. That's about 7% lower. We are, 6.5% lower from there. But we haven't checked Greg's this morning. How are the mighty Greg's? They're up 2.3%. Let's hear the gallery cheer there as they're feeling very smart with themselves. So, yeah, they're now up. Well, that's about 5% up. They are.
Yeah.
Lunch on them.
Exactly. Yeah.
But yeah, you look at the UK retailers. Curry's now open.
Wow. What is that? Is that 13? 12 now?
That is indeed. That is what happens when you beat guidance by, 5% at the low end.
Exactly. Yeah. Oh, fantastic. And yeah, like great trade, whoever sort of is on that.
That is, and it's really nice to see that there's just a chance that, you can go into a store and you receive great service.
Exactly, yeah.
And they've got every product you'd be interested in.
Yeah.
And, it's good to see that can, no matter what the woes are in the high street and the cost of living crisis and everything.
Yeah, for sure.
You're still getting that
No, exactly,
reward.
exactly. Yeah, exactly. And you can't be good customer service. So love to see that.
That's it. As we know in Greg's, that's why they warned.
Exactly.
I won't go into it. I was about to explain to Will the whole ketchup saga, but we'll I'll run you up that.
Do it off air, maybe.
Off air. Right, let's see the list. I missed that comment from the gallery. They all think it's funny enough. So yeah, it's like when teacher says, "Oh, share your joke with class, will you?" Vistry up 5%, Bellway up 4%, Persimmon. So those home builders really getting a move higher today. We might have actually had something out in Vistry. Let me check if there was. Yeah, there was. There was an update.
Interesting. I think there's a real sort of consensus from one from a bit of policymakers, but also from the public in general to have more sort of homes being built because housing is so expensive right now. And it's just taking up all your sort of income if you are trying to buy a house. So it doesn't surprise me that home buyers are sort of flourishing a little bit right now.
Yeah, absolutely. So Persimmon yesterday being rewarded as saying that they've managed to build slightly more homes than expected, and then Vistry being rewarded today just basically for not warning again.
Fair enough.
Because that's been a horrendous trip for them. So yeah, your delivery is good, up 3. Was as I said, Severn Trent, another one of those utilities that really benefits from gilts stopping to go down, I guess. WH Smith up 2%, and Wetherspoons. You look like a bit of a Wetherspoon man, Will.
I'm definitely not snobby to Wetherspoons. Happily get involved in there if it's the best option, for sure.
I think, yeah, the way my trading has been recently, then Wetherspoons and Greg's is my future. So I should embrace it. Right, let's have a quick look at the FX and commodities. So, excuse me for that. Yes, not really. There we go. So oil, 77. It's that tricky. That's your real worry for inflation, isn't it?
Yeah, exactly. And I think it'll just carry on sort of rising. If I'm being honest, I don't see it cooling down anytime soon.
Yeah. So you've got oil, you've got gold at 2,683. Interesting. So it's creeping its way up. This, of course, ahead of this huge number at 1:30 this afternoon, when you can, kind of forget everything as it is now.
Yeah, exactly.
And,
well, exactly. Yes, it's been very exciting, and as I say, everyone is sort of looking at this in terms of what's next, for instance.
That was interesting. Just AP it was that mentioned sugar earlier. It's not one that I pay attention to at all. But yeah, that's been pretty dire, hasn't it?
Yeah.
Oof, back to the lows from October 22, which is when everything bottomed.
Yeah, exactly. Yeah.
So yeah, interesting.
One to do more research on for sure. Yeah.
If is Tate and Lyle even still listed?
I honestly could not tell you.
That get bid for? Oh no, it is. So how's Tate and Lyle been? Or did they get? As you can tell, I think I traded Tate and Lyle back in 2006, 2005. So yeah, it's good to see that it is a similar path. But good. Right. So I think we've covered quite a lot. Will?
Exactly. Yeah. No, definitely.
It's been wonderful having you on.
Thank you very much.
What are your plans as you now come into a new job, get your feet under the desk?
Yeah, so just sort of going through the onboarding process right now in terms of doing all these sort of assignments and learning the platform back to front and the sort of trading systems as well. So it's it's fun, and also it's great being on the desk, just hearing these guys chat to their clients and getting familiar with everything.
And if for the viewers that haven't been on the floor yet, we'll do our best to get you all on the floor at some point. But just give them a little walkthrough. Explain where your desk is compared with where trading is and the vol desk.
Yeah, so we're all basically running to each other. So with the PCM's desks, there are about sort of 20 of us. We're all sort of huddled in the middle, and then to the left of us, you've got the traders, and then the vol desk as well. So a great sort of buzz, noise on the floor, which is obviously exactly what you want.
The best day I've seen so far. So I guess I've been coming in about what's it now? 5 months. We're coming up to our 100th show next month.
Wow.
I only did the math on that at the weekend. Yeah. So, but the best day has been the budget.
Yeah.
The UK budget. Everybody, because of course you were waiting to see is Rachel Reeves going to put money on tax on gambling.
Yeah, exactly.
Or is there, what are the tax rises going to be? And everybody, we had the TVs on. Axel was sitting next to me doing live reports. I was doing a TikTok or something silly like that. And it was.
That sounds great. Yeah, for sure. Yeah. As
opposed to the US election, when 3 of them had to stay the whole night.
Oh, really?
Yeah.
It
was on Emma and was Lefty in? Maybe Lefty, I think, yeah. But not Chris De La Vega. So now that you've done it, clearly Chris has to come on the show at some point, doesn't he?
Well, he's the one that deflected onto me, so
he did.
I think he owes me a little bit now.
That's exactly how this happened. I went on the floor yesterday to get somebody in for today because we thought we can't do that to Luke Moore. First day back from holiday, and he's sitting here at 7:30. So I went across to Chris De La Vega, who's been at IG for about 47 years. And I said, Chris, how about tomorrow being your first day? And without an even thought, he went, come and meet Will. It's his 3rd day.
Thanks, Chris, for that. But no, I've really enjoyed it. Thanks very much.
Good stuff. Fantastic having you on. We'll be back with Isar in 5 minutes for some psychology of markets and a deep dive into today's CPI. Planning to make investing your New Year's resolution? IG Invest brings their trading expertise to a brand new, simple and user-friendly app. With 0 commission on US stocks, why wait? Download IG Invest today.
Bring me the next shiny new thing. Bring me the next shiny new thing. Hi, I'm Sean Mearson, Senior Market Analyst at IG, and join us for our new show, Charting Essentials. That's every fortnight on IG.com, our trading platform, as well as YouTube. And that's a show where we look at everything technical analysis, hoping to help you upskill. Whether you're starting out or just looking to level up, we got you covered. In each episode, we'll break down complex concepts into easy to understand lessons, provide practical tips to help you sharpen your chart reading abilities, explore powerful technical indicators and their real-world applications, as well as guide you through hands-on examples to reinforce your learning. So come, let's work on our skills. Let's get better at this. Let's accelerate that trading journey, learn to have confidence to trade, and make informed trading decisions.
Welcome to the exciting world of options trading. If you're looking to add a new dimension to your trading strategy, you're in the right place. Options trading offers unique benefits that can elevate your investing game. With options, you can protect your portfolio against market downturns, essentially creating an insurance policy for your investments. Now, what sets us apart is our commitment to your success. We provide extensive educational content to help you understand options trading inside and out. And with our 24-hour servicing, support is always just a call away. But that's not all. Options also allow you to generate income from your existing positions. Strategies like covered calls let you profit even when your stocks aren't making big moves. Options also shine when the market isn't following a clear direction, whether prices are rising, falling, or staying flat. There's always an option strategy you can use to potentially benefit. Now, we offer two ways to trade options: listed options for US shares, ETFs and futures, and over-the-counter options through spread bets and CFDs. Both types give you the ability to take various market positions. So, ready to explore the potential of options trading? Well, open an account today and take your first steps into this dynamic market. Remember, while options trading can be rewarding, it comes with risks. Always trade within your means and never risk more than you can afford to lose.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
Rise and shine with IG's new morning show, Trade Live with IG, covering all our UK product offerings, including our OTC and exciting new US listed products. Starting in September, join us every weekday from 7:30 to 10 a.m. for exclusive insights from our trade desk, expert trading concepts curated by our friends at tastylive, global guest appearances, and loads of viewer interaction. Regular platform feature highlights and up-to-the-minute market updates. From casual chit-chat to in-depth analysis, we've got your morning covered, live on IG.com, YouTube, and in IG's trading platform. Whether you're a seasoned professional or just starting out, there's something for everyone. Tune in, stay informed, and kickstart your trading day live with IG.
Right, it's very funny. We're just sitting here talking about the market yesterday.
Yeah.
And I was saying it was one of those horrible,
Pretty brutal day, right?
sessions. Yeah. Let's have a quick look at the intraday and we'll see exactly what we're talking about. So the 5-minute chart there.
Look at that! Wow.
Right. Guess where the PPI came out, right? So we had a huge rally.
Yeah.
Which was actually ridiculous because it was up 40 points. Wow. Now, the PPI is relatively, I'd call it a tier 3 number.
I think it's only a tier 2 number when you look at it in conjunction with CPI, because when you look at the number the Fed really cares about, which is PCE, it's a weighted average of the two. And so PPI is only kind of making a difference at the margin relative to CPI, yeah.
At the very margin. So for the S&P to move 40 points, when the expected move for the CPI today is only 55 points.
Yeah.
Was ridiculous. So I can see why. But I did not expect the market to sell off and go right through.
I know, yeah, crazy.
The lows, 58.10, and then for absolutely no reason at 5:30.
Nice bounce.
we get right up in everybody's face, and then back down again, and then back up again.
It's so funny. So I was looking at this chart yesterday, and I was like, what do I want to talk about with Rich today? And I think sometimes we come on the show and we talk about kind of general psychological phenomena. I think if I want to think about psychology as like an actionable way to think about trading, we also have to think about the kind of context we're in. And I think, so today what I wanted to talk about was intraday volatility and interday volatility. So intraday being how much volatility we have between market open and market close, like yesterday. Yeah, exactly. And so we should talk about that a little bit. And then interday volatility, which is from market close to the next market open.
Okay. Right.
Yeah, and I think right now is
of hours.
Exactly. Yeah. So I think
moves and everything.
Exactly. So I think now is a really, really important time to talk about it, because we have sources of both types of volatility. So you have, for example, events that happen during the day, things like rate decisions, things like some of the major speeches or data releases, but actually the majority of big events that are happening right now are actually out of market hours, whether those are early morning data releases, whether those are earnings announcements. And so you actually are seeing a lot of the volatility happen not just within the market trading, but like outside of typical market hours.
And are we generally talking about US specific?
So actually that's the other thing which is interesting, which is so a good example to me of where a lot of the outside of market hours volatility is coming from is actually outside of the US. So Japan will be doing rate decisions at all sorts of horrible times in the morning.
Yeah.
And I think we now live in a world where it's possible to trade outside of market hours much more than it has been in the past. That doesn't mean it's always a good decision to do that. Volatility can be very low, and volumes can be very low, liquidity will be low, and volatility can be very high. And actually, it can be sometimes very hard to get out of positions. And sometimes people actually, if you have a extended market hours position, you can get stopped out outside of market hours, which is awful. And so I think it's actually more generally about how we even think about kind of when we're on and when we're not on.
And so where do you start looking at that, and how do you feed it into your trading decisions?
So I think there's a few things to think about. Number one is to have a good forward time horizon of likely events that you think are like trigger moments for large moves. And so I think when you look at yesterday, that's a great example. Yeah.
And if there's only 1 hour that you spend at your screens this whole week, it's this afternoon between 1:15 and the market open. And that's what I kept on arguing to my boss. My boss used to say, you sit at your desk at 6:15 every single morning, right? And you get there. So I'm sitting from 6:15 to 8 a.m. And sometimes it's a quiet market open. But I was the only one on that Credit Suisse floor at 7 p.m. on a Fed rate decision.
Oh, wow. Okay.
Right? So I'm like, look, I'm not coming in at 6:15. I'll come in on a quiet day at 7 a.m., but I'll stay till 8 p.m.
And I think what you're talking about there actually is also the challenge with trading nowadays, especially with quite extended hours, is we struggle to stay cognitively and emotionally and motivationally on for that whole period. It's just a really long amount of time. And actually there were two psychology theories competing about motivation, right? Which was, the first theory was a theory called ego depletion, which was this idea that essentially we have a kind of willpower battery, and then that willpower battery drains over the course of a day, and then we go to bed and it recharges and you start the next day. So if you're choosing to stay on in the morning, it's very hard to stay on in the evening. So that's theory one. And then theory two is this idea that actually it's not really a battery, so to speak, or if it is a battery, we can do things during the day that helps recharge the battery. And so actually there's
I like this, because I can see where you're going with this.
Well, so we've actually done research. We know which one is right. And actually it turns out the ego depletion example, where it's just a battery that drains, we know for a fact cognitively is wrong. That's not how our brains work. It's not how motivation works. And so then you have to try and, if you are going to do a really long day, especially a long day that feels emotionally very intense, where you've got a lot of swings up, swings down, where you feel like you're making tough calls.
Surge of adrenaline as the number comes out.
Yeah, so we actually know for a fact that motivation isn't purely draining, and there's things you can do to boost motivation. And so like it's worth thinking about what some of those things are. So we know for a fact taking a short break and having some sort of sugary food is like actually like evidence-backed way of having a little recharge moment.
Okay.
And actually the returns on breaks are better for short breaks than for long breaks. So regular short breaks are better for your motivation than having a big chunk of time off.
And give an idea of what a short as opposed to long.
So they did studies where actually you can do breaks as short as about 5 minutes. And that can be really, really helpful, just to have like a little pick-me-up moment where you recharge.
Which is funny because in the old days, the guys would argue that
smoke break. Yeah, exactly. Yeah.
Which is also great for networking as well.
Yeah, well, okay, maybe a separate conversation, but the top 3 cognitive enhancers that are legally available and that you can access are, number 1 is caffeine. Helps your brain work a little bit quicker.
Yeah.
Number 2, which has way more side effects and I don't recommend at all and people shouldn't do, is nicotine. And actually, but there is evidence that shows that nicotine is a cognitive enhancer, helps your brain work faster for a very, very short-term basis, but then long-term actually is bad for you.
Yeah.
And then the third one is there's like a range of supplements that can help your brain kind of work faster. But of all of those 3, what has a cognitive enhancing effect can be a 5-minute break and can have sugar, depending on how you consume it. Probably a coffee. And so when you're thinking about things you can do to recharge, like having a moment to have like a bit of a reset is really important. I don't know if people at home know this, but Rich regularly takes short breaks to get a hot chocolate in between the show. There's actually a really good example of motivation enhancing like short breaks.
Yeah, and I must admit, it's not necessarily always because I want a hot chocolate.
No.
It's the same with, so when I was at the hedge fund, we were in St. James's.
Yeah, beautiful area.
And it absolutely brilliant. But running out, there's a little shop down an alleyway there. And running into there, they do an iron brew.
Yeah.
And a nice chocolate bar. And it was usually a boost.
That's one of the most Scottish things I've heard.
Yeah, exactly. And some haggis.
Yeah.
And yeah, a quick run down there.
Yeah.
And you're back. Or if it's the European markets closing at 4:30 and there was a Fed meeting.
Yeah.
Then we go for a jog around Green Park.
So the thing that's good about both of those things is you also get outside. So one of the other things that we know helps recharge the battery is like fresh air and actually a different physical environment to where you're in normally. And that actually is weird. So they've done a bunch of studies of all places on astronauts, because astronauts have a very limited amount of physical space that they operate within.
Yeah.
And essentially one of the weird findings that they have that was actually applied a lot during COVID when people were locked down is that even if you are in the same space, you want it to feel different for different tasks. So even if you're working in your bedroom, for example, it's really, really good to have a slightly different physical setup when you're in kind of work mode from when you're in sleep mode. And so what astronauts literally do is they reconfigure the rooms they're in when they're in different like operating modes.
I can just imagine Carl Wolf and Monkey Man at home moving their
jazz
around. Just before the Yeah, well, there we go. A question from Carlo. I'm on the charts from 7:30 till 10 a.m.
Yeah.
Break for an hour, and then back on 11 a.m. till 2, so it's a 1 hour break. Short breaks to bake a brew. Yeah, got this from a mentor for autism, and it works. And I can imagine that thing, like, you've got to find what suits you.
Yeah.
But you can't argue with the research, right?
No, and I think the other thing is what I like about that suggestion is it's a bit ritualistic. Like we are like habitual animals. We like routine and we like structure, and like building a bit of structure actually helps from a motivation side because it gives you a good understanding of how long you have on before a period of time off. And so that's really nice. The regularity of that is good. There's some like interesting stuff on like generally how we like these kind of structures and rituals. But basically, if you want to be high performing, what you want is process stability, content agility. So the process you're using is like relatively stable over time. Like the way that you research things tends to be like broadly stable. The breaks you take are broadly stable. Yeah. But the stuff you do in the time that you're on needs to flex to the environment you're in, and that's kind of the optimal way to like build a routine and build a time.
And run us through the phrase again.
It's process stability and content agility. So you're like being much more flexible about what you do in the time, but the time is structured in a pretty consistent way to help you.
Nice. So that's us like having the show as the opening bell.
Yeah, exactly. But what we talk about in the segments might be different. They might be thematically similar over time, but they're like the content is different. So I think that's really important. All of those things can kind of recharge your motivation battery during the day, which is especially important during quite volatile periods. The other thing worth thinking about when it comes to volatility is like how to control and understand and actually just like be aware of your emotion level. So I think especially during volatile periods, everyone's like tensions are running a little bit high, emotions are running a bit high, and so then you might make rash decisions in both directions. So actually, just before we came on the show, you were talking, Rich, about how actually if you've banked some gains this morning, post UK CPI data, like your instant feeling is like maybe you want to cash out some of those gains. Yeah. And I think really having the ability to step back a little bit and think, okay, CPI was good this morning. We have a risk event later in the day when you've got the US CPI, but actually that's not for a while. We have a little bit of time to maybe let those positions breathe. We've got a reaction from the UK bond market and a reaction from cable, but neither of those reactions are actually crazy strong.
No, and gilt's given it some of it up as well, actually.
Yeah, exactly. So like maybe there's room for those positions to move. Maybe you think that position has run its course, but just making the decision to close it based on the fact that you want to bank the win, like that's not the right call, right? So you have to have that ability of knowing, okay, I want to bank the win because that feels emotionally good. But the cognitively difficult thing to do is go, okay, I know it feels good. Let's put that in a little box and be aware of it because it's good to know that. Like in our other box, like if we were to open the position today at where it is today, how would we feel about that position? And I know this is something that I come on the show like every week and I tell people to do, but basically think about the decision as if you were to open it today.
Okay, so let's put this literally into practice, right? Yeah. Vodafone. Let's have a look.
Your beloved Vodafone.
My beloved Vodafone. Because today automatically, right, I've seen it at 66 pence.
Oh, it's broken out of the little channel you had.
Oh, that's very well noticed, Isar. That wasn't even why I was coming onto it. But yeah, let's try and get that a tight.
Yeah, I mean, yeah. So I think this is a perfect example. If you saw this and you knew the CPI data and you were opening a position today, how would you feel about this position?
Well, okay. Well, that's now that we've actually seen that it potentially. Now that's just my drawings.
Yeah.
Right?
Yeah,
so they might not.
Yeah, we probably need Axel on.
Yeah, we do, don't we? So let's kind of update. It's certainly getting to the point, but it's almost beaten into me now that Vodafone can't sustain a rally, right? Every time it rallies from, 3 pence, then they hit it back down again, right? Every single time. So now that it's rallied 2.5 pence, then it's drilled into me, take profit, because that good feeling might disappear and might be taken away from you. But one day, potentially, and my underlying fundamental view is that this thing rallies 6 pence, 10 pence. So
I think the other thing that you've just done there that I think is like so common is assume that the decision has to be a binary.
Yeah.
And I think this is one of those things where like it's cognitively like much easier for us and emotionally much easier for us if we treat something 100% as a win or 100% as I need to cut my losses and lose, when actually like maybe you would open a position now, but at a much smaller size. In which case, what should you be doing? You should probably be selling a portion of your position and keeping.
Slicing.
Yeah, exactly. And I think that's often a good way to de-risk. As you go through, it's a good way to make sure that when you're banking those profits, you do it on a kind of more sustained basis. But I think during periods like this, where there is just heightened volatility, I think those emotions are like have you ever seen Spinal Tap? This is Spinal Tap.
No,
it's like a mockumentary about a metal band or hard rock band. It's really good. Highly recommend everyone at home to watch it. It's a great film. It was one of the earliest mockumentaries ever made. But they design a amp that instead of just going up to 10 goes up to 11 because 11 is louder than 10. But it doesn't actually change the amp at all. But during periods of heightened volatility, our emotions are dialed up to 11.
Yes.
And so all of those things that we struggle with on a normal trading day, during earnings season, during big events like CPI, all of it just feels even more extreme. And so then thinking a little bit about trying to implement those best practices that we're trying everyday trading becomes even more important, and it becomes harder. So we need a bit more of the discipline and a bit more of the kind of motivation battery to do those things.
Okay, great. Right, now that Isar has mentioned the hot chocolate, we're going to take a very quick 2-minute break, and I'm going to run and get a hot chocolate, or somebody from the gallery is going to run and get a hot chocolate for me.
Perfect.
Which one do they want? Do they want?
You should go do it, because then you get to change the scenery, and it boosts your motivation a little bit more.
So we need, or maybe 1 minute. Let's see, time me. See if I can get back in a minute. We'll take a very quick break. Then we're coming back for a deep dive into today's CPI. What do you need to know, and how do you prepare for it? Or are we? We'll see you in 2 minutes.
Welcome to the exciting world of options trading. If you're looking to add a new dimension to your trading strategy, you're in the right place. Options trading offers unique benefits that can elevate your investing game. With options, you can protect your portfolio against market downturns, essentially creating an insurance policy for your investments. Now, what sets us apart is our commitment to your success. We provide extensive educational content to help you understand options trading inside and out. And with our 24-hour servicing, support is always just a call away. But that's not all. Options also allow you to generate income from your existing positions. Strategies like covered calls let you profit even when your stocks aren't making big moves. Options also shine when the market isn't following a clear direction, whether prices are rising, falling, or staying flat. There's always an option strategy you can use to potentially benefit. Now, we offer 2 ways to trade options: listed options for US shares, ETFs and futures, and over-the-counter options through spread bets and CFDs. Both types give you the ability to take various market positions. So, ready to explore the potential of options trading? Well, open an account today and take your first steps into this dynamic market. Remember, while options trading can be rewarding, it comes with risks. Always trade within your means and never risk more than you can afford to lose.
right? We've got our hot chocolate, and Isar's got to manage to really annoy one of the engineers in the building as well by taking a glass of water from the tap.
A lot done in 2 minutes.
Yeah. Right, so on that, we just talked about taking a little bit of profit. So I have got 80,000 shares at the moment.
This is in Vodafone, right? Or,
yeah, I'm going to take 15,000 of those off.
Cool. But that still leaves some of the position on, which I guess, like we spoke about, is maybe now is the equivalent time you would have bought a smaller stake just to see how it plays out.
Yeah. So that's about a fifth of the position.
Cool.
Yeah, makes sense. Right, there we go. Right, that's done. Now we move on to CPI.
CPI.
So let's look at those.
And sorry, to be clear to viewers, we're talking about US CPI rather than CPI from the UK, which came out this morning a little bit cooler than expected.
That's right. So shall we have a look at the historical? So there's the year-on-year move.
Yeah, wow, look at that move. This is, so, okay, the reason I think this is really important to look at is a few things, which is the number that most economists and market people care about is your month-on-month number. Mm-hmm. The number that, like, kind of more macro, like nerds and the Fed care about is a rolling average number, normally a 3 to 6 month rolling average. But the number that most people on the street care about is your 12-month number.
Yeah.
And so actually what you'll start to see is we have a couple of months where the historic, this is core, right? Or was this?
That's core.
Yeah,
correct.
So if you look at core month on month, in December of last year, we had a 0.3% or 0.2, yeah, there you go, 0.275% core. And then we had a relatively hot January print, a relatively hot February print, and a relatively hot March print. And then it really cooled down in April, May, and June. So as we get new readings, you kind of drop the oldest reading in the 12 months.
Yeah.
And so these are what are called base effects. And so actually we have a period of time now where the base effects are quite strong from December to March of last year.
Yeah.
And then as soon as we get to kind of April, May, June, we've lost all of those hot readings. And so we're replacing whatever the new readings are with, like, look at the June reading. The June reading was basically flat. CPI was like 0.1, right? So, so if we're really worried about headline inflation, I would be super, super worried about headlines starting to tick up in May or June or
very much so.
July or August of this year. And so what that means is going into those periods, every inflation print between now and June is going to be quite a big, important print to see what happens to those headline numbers. So I think that's kind of like a macro perspective. And I think if you trade on, so like there's different type of traders, right? You've got people who kind of swing traders, people who are like more longer term momentum traders. You have like your fundamental traders. Like I think of myself more as like a regime trader, which means my time horizon is like 3 to 6 months normally, maybe slightly longer depending on the point we are in the economic cycle. But if you're looking on that kind of time horizon, it's really important to think about those base effects because A, people in the street think about that headline number a lot, and B, it drives inflation expectations, and inflation expectations drive the Fed. And so if we're thinking about like Fed whispering, one of the things they say in every single meeting is inflation expectations remain broadly anchored based on broad measures of broad surveys of inflation expectations. And what they mean by that is the Michigan survey, the other Federal Reserve surveys, and things like agent surveys in the UK is the equivalent. So anyway, so that's all really important context to think about prints in the next couple of months. I think when you look at today's print, the market is expecting somewhere between 0.3 and 0.4. I think consensus estimate going into this week has been 0.3, but actually this is, sorry, for headline month-on-month CPI. Okay. But if you actually look at what some of the banks are estimating, it's closer to 0.4, or it's in the high 0.3s. It's like 0.36, 0.37, 0.38.
Right.
And if you look at what the Cleveland Fed is expecting, which is an inflation kind of nowcasting service that the Federal Reserve has, they're also expecting slightly higher than 0.3%
Which is the first time in a while that's been the case.
First time in a while that you're seeing some forecasts above. That doesn't mean it's going to happen. And like, I think if people are trying to think about their positioning, I wouldn't actively be betting on inflation coming in hot, but it's definitely a possibility, and it's a possibility that quite a few people are entertaining. Even if it doesn't come in hot, 0.3% month-on-month inflation isn't great for the Fed, because when you look at that on an annualized basis, that's still well above.
Well above even where we've been tracking.
Yeah, exactly. We're well above where we've been tracking, and it's well above where the Fed's target is. We've had hot jobs numbers, and so actually you've already seen the 10-year yield basically on a steady truck upwards.
Yeah.
Over time in a way that's like actually fairly astonishing and relatively rare. It's very rare that the 10-year yield has such an increase in the aftermath of a rate cut decision.
It's 100 basis points.
It's more than 100. It's nearly 120 actually, which is really astonishing, right? And so I think going into that, everyone is a bit worried about that, and I think they're a bit worried for a few reasons, which is if the 10-year yield continues to tick up, what does it say about the Fed's credibility? I think that's a real problem. A second thing is like, what does it say about the government's ability to borrow and the interest expense that comes with that? I think the third thing is, what does it say about borrowers who are essentially borrowing off loans that are based off that 10-year yield, or even sometimes longer yields? And then finally, what does it say about markets in this slightly tighter set of financial conditions, and where, for example, if you are one of the few people out there who's doing like discounted cash flow modeling, if you're discounting future earnings at a higher rate, then it means your today's valuation of some of those stocks should in theory be lower.
I mean, and it's consistently ignored, you know, and this is something I actually did at the weekend, where let's see if I can get this back.
Did you build a discounted cash flow model?
No, a very basic one to show what happens. If we can just get that up, please, guys. I know it's not perfect on the screen, but looking at a 3.5% interest rate versus a 5% interest rate, and showing the difference. So 5 years out, your net present value drops from 84 to 78.
Yeah.
10 years out, it drops from 71 down to 61.
Look at that. Look at that. This is the magic of compounding, right? Look at that. Quite small difference in interest rates can have a really big impact on net valuations. And then the other thing is, like, when you normally look at government bonds, they're treated as a safe asset. And so actually, if you were to tell me, like, you can lock up your money for 10 years at 5% with no risk, I mean, that's quite appealing. And so then I don't want to do it with all of my money, but definitely a small portion of my money.
I got a message from Investec the other day saying your 1 year fixed bond is up in the next few days. Make a choice.
Yeah.
I think, well, do you want to offer me a 5-year rate?
Yeah.
You know, because it's been fantastic. I've done that for 2 years now. So I've done a 2-year,
Nice.
1 year.
Yeah.
Twice.
And by the way, that's exactly how you construct the yield curve, is by looking at, like, the 3-year yield in theory should be the equivalent of a 1-year yield now, plus what we expect a 1-year yield will be in a year's time, plus what we expect a 1-year yield to be in 2 years' time. Because the idea is that people like you can just arbitrage that yield curve if there are differences between expectations and the reality. And so the only thing that should then reflect is two things, which is how expectations of those rates are expected to change, and whether you want to put a risk premium on the fact that you're locking up your money for 3 years rather than having the option to move it somewhere else after a year.
Yeah. So just going through your 4 points there.
Yeah.
One on borrowers, right? Now, I argue we've never seen the likes of this before, because you had this big event in 2020
Yeah.
that everybody was offered cheap, almost free credit,
Yeah.
businesses and households alike.
Or at least very aggressive forbearance.
Very aggressive. and the government also was given opportunity to refinance. But every single month that we go on, then there's more borrowing coming up for refinancing.
Yeah, especially for the government, right? Where we, I don't know how many viewers watched our kind of New Year's episode, but we spoke a lot about the share of government borrowing that was in relatively short-term debt. And actually, part of the reason they did that was because they expected rates to come down, because they expected inflation to cool. And so if inflation isn't cooling, rates are not going to come down, and so refinancing that debt becomes more expensive for the government. And likewise for households, this is actually less of an issue in the US because a lot of household debt, especially mortgage debt, is very long-term and fixed. But what it does mean, it's very hard for people who own houses with a 30-year mortgage to move. And so then what you tend to see is in the housing market, there isn't as much inventory, there isn't as much turnover in houses because people don't want to lose the sweetheart deal they had that they got in, I don't know, 2010, maybe 2020. And so they're just not going to move. And in the UK, we have a slightly different phenomenon because you can typically fix for much shorter periods of time. Not to get too personal, I have a 5-year fixed mortgage that my household has that is coming up for renewal in 2026.
Well,
at the time, we thought, we thought, great. 2021, sub 2% rates.
Borrow as much as we can.
Yeah, exactly. And for as long as we can. And we were like, 5 years' time, even if there's a spike, it'll come down by then.
Yes.
And actually, we saw the spike in interest rates, but they haven't really come down.
Well, you saw it come down.
Slightly, yeah,
about
for sure.
a 3-month window.
Yeah, exactly. There was like this beautiful, like golden opportunity to remortgage. And I think actually what's really interesting in the CPI print today is whether we will see different stories in the UK versus the US. So we've seen cooler CPI in the UK. We've seen, to be honest, weaker economic activity in the UK. If you look at the UK unemployment data.
Two very different economies at the moment.
Right, yeah, exactly. And you can see that actually, I don't know if you've got cable up, but you can see the relative differences in cable where like the strength of the dollar has actually really been kind of the story of the last kind of couple of months. Like look at that, look at that since October. The real
134 to 122 is 10%.
That's crazy, right? And so I think that is telling you the story of a hot US economy and a relatively cool British economy. And so having CPI on the same day, I think is like a very stark comparison between those two worlds.
But we've already seen that move. But
how much more? Yeah.
Today, if we literally see US coming in hot, UK coming in lower, all right, then we're not going to get rate cuts in the US. We're going to get more rate cuts in the UK.
Yep.
But does sterling still react to that?
I don't know. It's hard to know how much of the move has been mentally priced in. The dollar is very, very strong at the moment. It's like record. Like you can look at the dollar basket DXY. It's very, very strong. Look at that. I mean, that's crazy, right? So I think, and
which
you can see
into Rachel Reeves' point yesterday. Was that Tory sit down? This is not a UK problem. It's not Labour.
Actually, the spread on yields between the US and the UK is actually narrowed, and so whilst the total numerical level of yields is higher than during the Liz Truss era, it's not reflecting a higher risk premium. It's just a general market pricing in higher yields.
Excellent. Right, Isar. So we can't let you go without giving us a shout. What do you think? What's the prediction?
Okay, so
a strong US economy.
Yeah, so I gave a hot jobs number prediction, which turned out to be, I think, the closest. You guys owe me a Greg's voucher.
The way round, actually, I'm afraid.
Oh, really?
I was.
You even know? Okay, fine. So I think if I was going to guess, I would say we had cool inflation reads in the UK. I would expect slightly hot, but not very hot, inflation reads in the US. So maybe it'll be 0.35, for example.
Right, which 0.351 or 0.349 is everything.
Exactly, because we always just round, right?
Yeah, so, well, the official.
I think it will round up.
Yeah,
is kind of my gut feeling.
Okay.
I'm not massively trading on that position at the moment because I think it's quite finely balanced to me. It could go either way.
To be honest, if it's 0.351, the market shanks down 50 ticks on the S&P 500, you're almost a buyer there because you look at the rounding error. So that's probably the best thing to take away from this. Look at the exact number. They do give you
It's up to 3 decimal places.
just
right?
below, 300.352 is the exact expectation, and then the seasonally adjusted one as well. Have a look at those, and don't just take the headline number as the truth. Excellent.
Perfect.
I think that's given us a good setup.
Yes, I'll see you in a couple of days.
Thank you very much. Join Angeline after the break. Planning to make investing your New Year's resolution? IG Invest brings their trading expertise to a brand new, simple and user-friendly app. With zero commission on US stocks, why wait? Download IG Invest today.
Bring me the next shiny new thing. Bring me the next shiny new thing.
Hi, I'm Sean Mearson, Senior Market Analyst at IG, and join us for our new show, Charting Essentials. That's every fortnight on IG.com, our trading platform, as well as YouTube. And that's a show where we look at everything technical analysis, hoping to help you upskill. Whether you're starting out or just looking to level up, we got you covered. In each episode, we'll break down complex concepts into easy to understand lessons, provide practical tips to help you sharpen your chart reading abilities, explore powerful technical indicators and their real-world applications, as well as guide you through hands-on examples to reinforce your learning. So come, let's work on our skills. Let's get better at this. Let's accelerate that trading journey, learn to have confidence to trade, and make informed trading decisions.
Welcome to the exciting world of options trading. If you're looking to add a new dimension to your trading strategy, you're in the right place. Options trading offers unique benefits that can elevate your investing game. With options, you can protect your portfolio against market downturns, essentially creating an insurance policy for your investments. Now, what sets us apart is our commitment to your success. We provide extensive educational content to help you understand options trading inside and out. And with our 24-hour servicing, support is always just a call away. But that's not all. Options also allow you to generate income from your existing positions. Strategies like covered calls let you profit even when your stocks aren't making big moves. Options also shine when the market isn't following a clear direction, whether prices are rising, falling, or staying flat. There's always an option strategy you can use to potentially benefit. Now, we offer 2 ways to trade options: listed options for US shares, ETFs and futures, and over-the-counter options through spread bets and CFDs. Both types give you the ability to take various market positions. So, ready to explore the potential of options trading? Well, open an account today and take your first steps into this dynamic market. Remember, while options trading can be rewarding, it comes with risks. Always trade within your means and never risk more than you can afford to lose.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
Rise and shine with IG's new morning show, Trade Live with IG, covering all our UK product offerings, including our OTC and exciting new US listed products. Starting in September, join us every weekday from 7:30 to 10 a.m. for exclusive insights from our trade desk, expert trading concepts curated by our friends at tastylive, global guest appearances, and loads of viewer interaction. regular platform feature highlights, and up-to-the-minute market updates. From casual chit-chat to in-depth analysis, we've got your morning covered, live on IG.com, YouTube, and in IG's trading platform. Whether you're a seasoned professional or just starting out, there's something for everyone. Tune in, stay informed, and kickstart your trading day live with IG. Welcome to the exciting world of options trading. If you're looking to add a new dimension to your trading strategy, you're in the right place. Hello, trader friends. Welcome to the show, and it's the all sessions opening bell where you get to take a position ahead of the Wall Street Open. With just seconds to go, we're going to be joined by Martin all the way from South Africa. Hey, Martin. Are you now back
Hi there,
in
Angeline.
London?
How are you doing?
Did you take the...
I'm not actually in London.
How are you? Happy New Year. We haven't spoken to you since 2024.
Yeah, that's right. So a little bit rusty. I took a break from the stock market for the last 2.5 weeks, but eager to chat about yields.
Yeah, hold that thought on yields. Just taking you through the all sessions right now because it's just out of the gate here. We've got Mara Holdings up 1.2%. Clean Spark also another all sessions up. And this is, of course, all linked to Bitcoin. Taking a look at some of the others as well. Alcoa up 0.75% too. Looking at Plug Power, because we know we've got quite a few trader friends watching. That's also up 1.8%. But Riot Blockchain, all those usual names, all they're bid up at the moment. So you can always tell that there's always interest when Bitcoin is near that 95 level or drops below that 95 level. Take a look at some of the reds for you. Lyft down 0.2%. This is the competitor to Uber. Nvidia also having a bit of a down day there early on, though it has to be said, down 0.2%. ASML also down 0.5%. Checking in on Moderna for you because it got whacked. I knew that because I watched Moderna, and it's down about 8% early. We're only a minute in. Also, Monkey Man, you were asking about Eli Lilly. I also have a holding in Eli Lilly. That was because the new drug that they came up with, this is to do with the obesity space as well, it was not as well received as expected. It disappointed. Last but not least, Qualcomm down slightly, all sessions as well. Right, Martin, before we get to yields, very excited, all of us here, about the incoming new all session stocks that are about to hit IG in 5 days' time.
Angeline, unfortunately, I don't know enough about what those new all shares stocks are going to be, but always interesting to kind of be able to trade both the pre and post sessions. So I think we'll probably have to get Aaron on to discuss what those could be.
Totally. Talk us about yields then, because that is also another interesting space. Rich and I have sparred over it. What is your view? I am slightly cautiously optimistic there. I think, of course, it can be more bearish, that picture, but in terms of returns, equities specifically, I think we'll still see decent returns from the US. What's your view?
Potentially. Look, I think that at near 5%, the 10-year yield is really putting a lot of downward pressure on economic activity through just the impact that we see on interest rate sensitive sectors. So the view that we have at this point is that we're almost at a peak hawkishness, and within this rate cycle, the slowdown of economic activity that occurs now at a 5% yield through multiple channels means that the Fed are not going to basically have the back up against the wall and can't raise rates further. So based on that, the current level of rates appears unsustainable, and really just given the mounting economic pressure. So that's our view on these peak rates at the moment.
Now, we've also seen, yields add pressure to, equity valuations. This could, in effect, turn around the, equity market party that we saw the last, few years. But, essentially, how is it going to impact, equity markets? And of course, we're in a time when, it's relative to everything in markets. Is relative, right? It'd be like a relative investor would think, well, it may not be as good in the US in terms of equities, but it might be a lot better than, Europe, for example, and
Sure.
the UK.
Yeah, so I think, we won't be able to get through all of this today. So very briefly, I think the way I'm looking at things, if we take a US view, the house builders are very interest rate sensitive. They've had a fantastic run. If you look at, I think KB Housing released their results in the last few days. I think it was 2 days ago, and they're delivering 4,000 homes per quarter. They've got revenues up 19%. They've got new starts up 17%, but the overall trend now is that new housing starts and housing and construction loans are starting to slow down, and that's because of these high interest rate levels. So that is a sector where, although fundamentally it's performing really well, the future outlook is suppressed because of these high yields. And then if we were to look outside of US, emerging markets, this really strong dollar is sucking in, and then these high yields are sucking in, currency from abroad, boosting US dollar. You're getting a great yield in the US, and that trickles over, what we're seeing in UK, Europe, Canada, and so on. And so EM looking particularly weak at the moment. And also you've got with that this kind of double sword of the Trump tariffs. So I think if investors or traders are looking for some sort of a catalyst in the future, I think potentially we could have some kind of turnaround in the EM space. They, heavily sold off, and if there's any kind of respite in the tariff scenario, and also if this kind of is peak hawkishness, you could then see a bit of a pop in emerging markets. So that's kind of my view there.
Just whacking up my chart now. This is the iShares MSCI Emerging Markets UCITS ETF, which you can get on the IG platform. Hold that thought and stay right where you are, Martin. We'll come back to you. We're just getting to the sting, and we'll come back to live from the trade floor. Hey, welcome back. Now, we were talking about emerging markets versus Europe versus US as well. And also, of course, yields, big story this week and the back half of last week. US yields, dragging up global yields and causing a huge amount of uncertainty out there. Take us through some of the things that you're seeing on your radar and what you are looking out for ahead of that CPI number, of course, and the start of the earnings season, which is later today. And I'm very excited because I like trading the earnings season. What are the key sort of pivot points that might change your thought process on arranging the smart portfolio?
So look, I think January, there's a lot of positioning changes that happen. And so we're seeing a number of uncertainties in the market at the moment. We're not looking to base the rest of the year just on this kind of short-term bearish signal. So I think in terms of where CPI is, obviously, if we get a lower inflation print, like we saw with the UK, that's positive because it means that we can continue to cut interest rates. However, and any cuts on the interest rates, really besides just the cost of equity coming down, what we're waiting to see and hasn't really returned to the market yet is that increase in M&A. The increase in M&A, typically, particularly in sort of software, small cap spaces, the benefit there is it often re-rates particular industries. And so if you get company in a particular industry, in a software industry now being sold at a higher multiple, it re-rates the rest of them because they realize that they're worth more. So that's really kind of the catalyst that we're waiting to see. So we need the rates to come down to start seeing more of that, boosts most of the markets. I think in terms of sectors that we are positive on, we like US banking sector and we like US technology. I actually scribbled them down, and I've now lost them. My PC restarted just as I joined this call.
That happened to me too.
Yeah,
a few weeks.
There's three sort of internet ETFs that we like. One offered by Invesco. I'll put them into the chat. One offered by Invesco. There's one from iShares, and there's one from First Trust. Really just looking at NASDAQ internet businesses, so looking at software companies rather than on the hardware side.
Is it the Invesco AI and Next Gen software ETF?
No, it's not that one. Let me try and find them while we're chatting, but it's not that one.
Loads of different ETFs on offer here on the IG platform. Whilst Martin is looking for that for you, you can easily just search Trader Friends by typing ETF, or you can search by the name of the provider. So for example, Van Eck will pull up all the Van Eck ETFs for you. You can also type in Han ETF. If you don't know the names, that's the Clean Energy Select one. And also Crane Shares is another keyword to use if you're looking for an ETF rather than an individual stock or financial instrument. What's really handy as well, which is what I use the ETFs a lot for, is that if I wanted to broaden my exposure to the exposure, not put all my eggs in one basket, I look into the ETFs and I have a look at how they structure it, how they split out their investments to see how they've diversified that sector. Martin?
Yeah, I've managed to find them. So the three that we like, this is really that they're all doing a similar thing. And so if you're looking for exposure to information technology and software, IXN, FDN, and PNQI are the ETFs that we like.
So IXM, the iShares Edge MSCI USA Momentum, is that the one?
That's the one.
Cool.
And
adding that to the workspace.
Sorry, the IXN. Sorry, Angeline, that's the wrong one. IXM for November.
Yeah.
N for November.
Okay, IXN.
So take up, yeah.
iShares Global Tech ETF.
That's the one.
There we are.
So this is a space that we like. You know, valuation multiples have trended upwards since September, accelerated after US elections. S&P 500 software industry index is currently leading, forward P of 34.4 times. So it's above its 1 year, 3 year, and 5 year averages. But we are mindful that there are rising multiples in this sector. As I mentioned earlier, any M&A activity supports this sector, and the growth trajectories are still strong. So the AI spend directly supports these companies, and so, you know, looking at like sort of within these ETFs, the kind of large platform vendors, broad sets of enterprise solutions. You've got Adobe, you've got Team, Microsoft, CRM now. You've also got the cybersecurity vendors, CrowdStrike, and so on. So that's the kind of space that we like.
Interestingly, Trader Friends, those of you asking what are the returns, the total return around 19% for 10-year, 3-year, 10%, 1 year, 25%. I guess that's not a surprise given the year that we've had in this space. What are some others that you like and are looking at, Martin?
I think potentially US banking stocks. There's, you know, some favorable fundamental trends there. We've got results coming out later today, I believe. Yeah. We're going to start looking at that.
JP Morgan for you.
Exactly, but I think really here is that the Trump administration is going to lay out new policies, less regulation is going to favorably impact capital markets and investment banking. These banks are going to benefit from the sort of markers. They're going to benefit from a growing US economy, less federal regulation. And so really we're looking at that trend. And that's the trend that we see overhead. So we've got we're sort of bullish on financial sector and global US banks. So that's really the view that we have. We're not looking at picking individual names, but yeah, a S&P 500 diversified banks index has outperformed the S&P 500, and we're looking to continue that momentum in that theme.
Thanks so much for those handy tips. I guess the biggie will be before the earnings, that inflation number as well. I'm looking at that core to see whether services are still sticky. ISOs looking at maybe a on the money or slightly lower. I'm kind of thinking maybe on the expectation or slightly higher. What's your view?
I'm at expectations at the moment. I have, as I said earlier, been sitting out of markets for the last 2 weeks. I think that the way that from what we're seeing in the yield, this very negative reaction to that we're getting these higher rates signals to me that the market doesn't buy a low inflation scenario. They don't buy a low growth scenario. So the market signals that the Fed is going to need to step in and raise rates. As I said to you earlier, where yields are pointing, any higher really suppresses economic growth. So we'll have to see what the overall response is going to look like. But I believe that we're going to should come in on expectations. But if it doesn't, that's where the catalyst comes from. That's where the traders get their opportunities. I don't really have a view on where CPI is going to print at the moment.
There's also a lot of talk. You mentioned, Trump incoming. Or there's been, whilst you've been away, Martin, there's been a slight recalibration. There was a moment last week when everyone thought actually his policies aren't going to be as inflationary as thought. That it might. Everyone's worrying about it's going to be a storm in a teacup. Then it came back to the U.S. tariffs are going to bite, and it's really going to start to affect global economic growth. So where are you sat on that fence? Or which side?
Look, I think we forget the retaliation that happens when tariffs are imposed. I think his pledge of imposing blanket 10% to 20% tariffs on all imports and up to 60% on Chinese goods, we forget how the Chinese are able to respond. And this really could just be a political kind of maneuver that Trump uses in order to get some leverage and then come to a deal with the Chinese. So there's a lot that is up in the air. I think we remember from Trump's previous term that the federal government had to step in and support the agricultural sector because of the tariffs that he imposed on imports on things like soybeans. So there's a lot of concerns there. However, I think we've got a team now, and Trump has surrounded himself with different people who are probably more economically literate and understand the impacts. And so I think really the main impact is going to be from the higher deficit spending. That's going to make up that's going to stimulate the US market, and that's where we continue to see this view on the US exceptionalism. And I mean, we could probably repeat all of the same things that have been said. United States, we've got these very levitating yields, we've got levitating valuations on market, this US exceptionalism story, how long can this continue for? And that's kind of the bear case on the United States. But we just need to wait and see, because the tariffs can quickly spiral into trade war.
It's really interesting, isn't it? And this spiral then affects inflation as well. I mean, last year, Martin, we were in a place where we kept on talking about how consumer price signals were relatively muted. Inflation seemed to be heading in the right direction, especially from the summer onwards. And then we saw attention kind of swing back to the employment component of the Fed's mandate. Now, start of 2025, it looks like it's swinging back again to inflation. Are we gonna?
So, yeah.
Yeah, it's like a
I think
pendulum.
market positioning, that's right. I think the market positioning tells a very compelling story at the moment. So the shift from pricing, I think we had 6 Fed cuts in January last year to just we're pricing in a 1 cut now. It appears extreme, and this is where, when we compare to the actual economic conditions we've had this trend of moderating inflation, rising unemployment, and that's where I felt that this hawkish kind of positioning looks difficult to sustain. That's my feel on things, is that we could, I would lean towards us having more than 1 cut simply because of the hawkishness of the entire scenario.
One of the key things too that we talk about quite a bit whilst you've been away. We've missed you terribly, Martin, but every time you go away, the world crumbles and gets set alight in places like LA. I don't know whether you saw the images. I hope not. I hope you had a good holiday and you didn't have any screens near to you.
Totally removed from the world I've seen. I have been watching the news. I can't help myself.
Yeah.
So somewhat there.
I had to plug in because I have a lot of relatives in the US, as you know, and luckily they're all safe that side of the USA. But it is, quite horrific. We're seeing only now the unraveling of the extent of how crazy the impact has been. I'm seeing 150 billion, estimates of how this is going to impact, some really big numbers like that. And of course, we're going to then go into that reconstruction phase. How is that going to feed into the data in the coming months ahead, and how might that impact the Fed's thinking?
Oof, that's a big one. It's not something I've thought about too much. I think that what you do get out of these scenarios is you get a lot of inflationary conditions due to the requirements of resources, so just building materials, labor, and so on in those areas. Those Pacific Palisades, that area that was affected, is a very high income, wealthy area. Huge amounts of value destruction, because you had these homes worth millions of dollars, all destroyed, potentially uninsured. It's going to be a massive cleanup operation there, and I think politically is also a huge signal for the United States. You've got an area, California, very Democrat focused, very focused on things that potentially don't matter in results, and you have an incoming Republican Party who said that really what should have happened is A, B, C, and D with regards to bringing in water, with regards to clearing the forest, with regards to all of these other factors that were completely removed by the local Democrat Party that run California, who have been, moving funding away from these sort of fire-related activities towards housing, immigration, and so on. And probably you're going to have a lot of people there turn against that sort of liberal democratic view and more towards the pragmatic conservative view. So very interesting time for the United States.
Indeed, it is. And, you spoke about KB earlier, but also I was trying to crunch some numbers late last night, which is why I messaged you right back at around 8 p.m. Was it 8:30 p.m. London time? And you sent me a picture of your blue screen. And that was what I was doing.
I've been having laptop issues.
Your laptop issues, I had that last week. It's like when you go on holiday here, it's like they're hot. Like, oh, this person isn't touched. We're going to lock down and upgrade the software. But backing up my chart, I was trying to look at companies like Lennar to see whether there's any impact in the months ahead, especially in terms of, the company's exposure, if you like. But what I'm also interested in is, for example, Walmart has quite a sizable exposure to that area. The other one is also Costco, Costco also has quite a large exposure to that area that has been affected by the wildfires. I hear Cam in the gallery chuckling there because he loves Costco. He keeps telling me about some sort of hot dog that I need to try because I'm
There's a hot dog there. I've never had the hot dog. I've had the pizza.
Really? They've got pizza in Costco?
Giant pizza, yeah.
I need to.
I think
Can I go in? Can I go into a Costco? Can I just waltz in, or do
you
I
have
need
to
a
be
membership?
No, you got to be a member.
Or do I need some sort of membership? I get thrown out if I try to
Yeah, you
waltz
need
in.
a membership. But you can get it from Cam. You can ask Cam if you can borrow his membership card.
Martin says I need some card to get in, or I need someone to bring me in. So you know what to do. I need to do market research on this. But you get what I'm.
It's a great, yeah. That membership aspect though is a great business tool because it's believed that it's like number one reason why there's less theft at Costco compared to anyone else because they've vetted everyone who can shop in the store. Lena's an interesting case. I think they came out with results 18th of December last year, and they were heavily impacted by the extreme weather conditions seen on the east coast of the United States that we saw, in the second half of last year. Whereas KB didn't have the same exposure to those weather-affected areas and did exceptionally well. So Lena, again, KB, both in the house builders. There's sort of 10 big house builders in the United States, and they're in there. I think the risk is that you have these high yields pressing buyer demand. The US buyer is also not sort of silly, and they understand that rates are supposed to be getting cut, rates are supposed to be coming down. The mortgages have not yet come down because of these long-term yields not moving in line. So until we see some kind of impact of yield curve control, some demand from that 10-year area to the 20-year on the yield curve, demand for those bonds, we're not going to see yields coming down. So it's really something that we are watching. So we're going to have to wait and see how Trump and the Fed start approaching these longer term rates.
At the same time,
but as an investor now, it's a good time to potentially get locked in. As I said, I think that we're approaching a peak hawkishness, and these could be, that 10-year looks quite juicy.
At the same time, I remember last time Trump was in power, he was, the whole kind of like stock market strength was a real medal, was a real kind of like thing that he used as a benchmark for success, right, for his presidency. And I just cannot see him not doing the same thing this time round again. And this is the thing that I am constantly thinking in my head. What is he going to tweak? Is it going to be like the tariffs that he's going to put out there is going to make up for the tax cuts that he said he will unleash? The efficient, or is it the Muskie's efficiency that is going to, create money that will then be folded into these cuts, right? And he's going to want to keep stock market strong, right? He's going to want to keep it going good, because then he can say on the podium, I made America great again. Look, you all feel richer. I'm going to keep prices down at the pump, but also you'll feel richer because your pensions will make you feel richer. So go out and spend, is the kind of commentary I've got in my mind. So, perhaps no market is going to be invincible. But at the same time, Rich and I have this kind of discussion the whole time, and I'm definitely not anyone that's political ever, but I kind of look at trends and what's happened in the past, and it's that kind of frog in water that you heat up slowly. The frog in the pan metaphor.
In the frying pan, yeah.
Yeah, which actually isn't true, because apparently they jump out. Apparently, if you turn it up slowly, they do jump out.
You've ruined the metaphor, yeah.
But you got it right straight away. Yeah,
I got it.
They actually, apparently they've done lots of studies on this, and they jumped out. Speaking of jumping out, some of the others that have, how many more minutes, Terence? 2 minutes. Some of the companies with exposure, and this is also one that I'm kind of looking at in the evenings when I've got a bit of spare time in my structure, like I was telling Carl and R6 Senna. Target is another one. I've got that chart up here. Obviously, not going to have an immediate impact, but maybe in the months ahead. Costco, I already mentioned. Best Buy as well, significant presence in the wildfire area, which has unfortunately caused some fatalities. JP Morgan also taking a look at some specific retailers like RH. AutoZone has 85 locations in that area. Just some time now to go through some questions from our trader friends. Fantastic question away from the numbers. We talked about this with Tom Watt from home last week, and there is no ETF screener. We have put this into the discussions with.
Don't worry, the ETF screener is coming. I'm working on that
there
as
you go.
we speak.
There you go. It's coming up.
It's going to take a few months, but give it sort of 2 months, and we should have that up.
Amazing. So I would love to have that screener too. In the meantime, if you do need to screen some ETF stocks, one that I use sometimes just because, ease of use, and whilst I'm waiting for our DevOps team to give me a date.
Is it going to be just ETF?
No, it's actually ETF.com. They've got a stock screener there. I'm whacking it up on my chart here. And what I like is on the left, I get to even filter. So they've got these filter buttons on the side here. I can filter by performance. I can also filter by issuer and index. And because I know quite a few of the issuers, I like to kind of use this filter. You can also use it for topics too. Monkey Man asking about, Ange, is there an ETF for disruptive stocks? Well, there isn't one that I know of, but I'm sure this filter can look for it for you. I use this, for example, for to choose defense stocks. I use this when I want to have a broad-based AI holding, not just in the hardware, but the software, but also the likes of the Microsoft that are most likely to benefit from AI spending. So diversity is key, especially when it comes to smart portfolios. And on that note, Martin, one key word ahead of that CPI number, what would it be? Key thought.
A single key word.
Or key thought. Don't use the frog in the pan, because I've ruined that metaphor for everyone.
Yeah, there was lots I had to say there. I think just thinking about Donald Trump again, if I'd go back to there's a double-edged sword. He obviously wants stock markets to fire. You get that entire wealth effect. People spend more, companies recruit more. As the stock prices go down, which we're seeing at the moment, you now have people spending less. You also will see jobs at risk, because the number one driver of jobs is actually share price, not earnings. And so that is a concern. Trump can affect potentially the short end of the curve, the middle and the long end of the curve. Really difficult. You need yield curve control. I think ultimately he would have to get on sides with China again for the Chinese to come in and buy more US debt in order to get those yields to come down.
Brilliant. Thank you very much, Martin.
My last thought.
That was very succinct. Thanks very much, Martin. We'll see you soon, and welcome back from your holidays.
Planning to make investing your New Year's resolution? IG Invest brings their trading expertise to a brand new, simple and user-friendly app. With zero commission on US stocks, why wait? Download IG Invest today.
Bring me the next shiny new thing. Bring me the next shiny new thing.
Hi, I'm Sean Mearson, Senior Market Analyst at IG, and join us for our new show, Charting Essentials. That's every fortnight on IG.com, our trading platform, as well as YouTube. And that's a show where we look at everything technical analysis, hoping to help you upskill. Whether you're starting out or just looking to level up, we got you covered. In each episode, we'll break down complex concepts into easy to understand lessons, provide practical tips to help you sharpen your chart reading abilities, explore powerful technical indicators and their real-world applications, as well as guide you through hands-on examples to reinforce your learning. So come, let's work on our skills. Let's get better at this. Let's accelerate that trading journey, learn to have confidence to trade, and make informed trading decisions.
Welcome to the exciting world of options trading. If you're looking to add a new dimension to your trading strategy, you're in the right place. Options trading offers unique benefits that can elevate your investing game. With options, you can protect your portfolio against market downturns, essentially creating an insurance policy for your investments. Now, what sets us apart is our commitment to your success. We provide extensive educational content to help you understand options trading inside and out. And with our 24-hour servicing, support is always just a call away. But that's not all. Options also allow you to generate income from your existing positions. Strategies like covered calls let you profit even when your stocks aren't making big moves. Options also shine when the market isn't following a clear direction, whether prices are rising, falling, or staying flat. There's always an option strategy you can use to potentially benefit. Now, we offer two ways to trade options: listed options for US shares, ETFs and futures, and over-the-counter options through spread bets and CFDs. Both types give you the ability to take various market positions. So, ready to explore the potential of options trading? Well, open an account today and take your first steps into this dynamic market. Remember, while options trading can be rewarding, it comes with risks. Always trade within your means and never risk more than you can afford to lose.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
Rise and shine with IG's new morning show, Trade Live with IG, covering all our UK product offerings, including our OTC and exciting new US listed products. Starting in September, join us every weekday from 7:30 to 10 a.m. for exclusive insights from our trade desk, expert trading concepts curated by our friends at tastylive, global guest appearances, and loads of viewer interaction. Regular platform feature highlights and up-to-the-minute market updates. From casual chit-chat to in-depth analysis, we've got your morning covered, live on IG.com, YouTube, and in IG's trading platform. Whether you're a seasoned professional or just starting out, there's something for everyone. Tune in, stay informed, and kickstart your trading day live with IG.
Welcome back to Market Measures. So if you trade Tesla, if you trade gold, JP Morgan or Goldman's, this is a special Market Measures for you because we're looking at what happens to stock market around Trump's Inauguration Day. Sahil's been through all the details and this is a cracker. So
excited.
Trump will be officially inaugurated as president this upcoming Monday. As such, traders will seek fresh opportunities in the market that arise with the change in leadership. This Market Measures will go over the numbers and trends surrounding that Inauguration Day, as well as the previous one back in January 17. Now, what opportunities can you look for in the upcoming week? So we're looking at the 3 days before and the 4 days after. So since the launch of the S&P 500 in 1957, US stocks have generally not performed well on Inauguration Day of a new president. But on the day Trump took office in 17, all three indices rose by a significant percentage, marking a significant deviation from the trend. Now, there's the different sector ETFs in the days surrounding that inauguration in 2017. So you can see the underperformer was healthcare, boring defensives, and the outperformer, consumer staples, actually.
Interesting. Ahead of tech.
Yeah. Yeah. Now, there you go. And there's your stock market trends surrounding those inauguration days. Do you want to run through the big winners from the first few months?
Thank you so much, Sahil. I have been waiting with bated breath for this piece of analysis for myself and Rich, because I thought no one's really done this, and we can get a whole team, the wonderful research team at Tasty, led by Sahil, to do this. So Align Tech was the biggest gainer, 150, almost 154% there, if you round it up. Micron, more than 90%. Boeing, also up near that 90 mark. Nvidia too, behind.
Before anybody really knew what Nvidia even was.
Oh, well, I did, but you know, the geek in me going, yeah. PayPal, 80, almost 82%. Wynn Resorts, those of you that look at this space, 80%. Of course, Trump has talked about deregulation for some time. Vertex, one that I'm not very familiar with.
Yeah.
DR Horton, House Builders, 76%. And Red Hat, that one I know. They build drones.
Right.
And they are one of the key stocks I'm looking at the moment, because their USP is that their drones are modular, and they have recently cut a deal with Palantir. Palantir supplies them with software that gets their drones the eyesight that they need.
Yes, brilliant. Right, what about the losers? Healthcare and energy stocks performed the worst during the first few months of Trump being in office. So you can see Hewlett-Packard there, GE, Under Armour. I mean, I think just Under Armour was going through a terrible time there anyway after overspending on marketing. Mattel, the toy maker, Baker Hughes, and Range Resources. Now, what about gold, right? This is the really interesting one. Following the election, gold dropped from record highs but rebounded to 2,650. Policies of tariffs, spending, and tax cuts may potentially strengthen the dollar and weaken gold. I mean, can it strengthen the dollar any more? That's the big question. But increased global uncertainty could definitely boost demand for the metal. Despite expectations that higher rates would lower gold prices, it's reached record highs, possibly due to concerns there about the debt stability. So there you go with the expected move, 252 down to 241, 2.2%, 7-day is the standard deviation. Now, during his campaign, Trump pledged to boost the economy and suppress inflation by increasing oil and gas drilling. Drill, baby, drill, potentially allowing an additional 3 million barrels per day on federal lands, despite skepticism from Exxon's upstream president. Although the US is already the world's largest oil producer, this increased supply could lower prices. So then you've got to start measuring that against Middle East conflicts and also the OPEC actions as well. So yeah, expected standard deviation of 7% in UNG, and in USO, we're looking 5% on the 7-day. So yeah, some really interesting opportunities there around the energy complex. Now, Ange, do you want to take us through this one?
Nice. And leading US financial institutions, this is a key one because we're on the cusp of the earnings season, may gain an advantage from what is expected to be looser regulation a la Musk and more beneficial tax policy after Trump's victory. Indeed, shares in JP Morgan, Wells Fargo, and Goldman Sachs, among others, all posted strong gains on election results day. I remember this as well. There was a great confidence around there. However, in the days surrounding the 2017 Inauguration Day, the three major bank stocks all went down, although not by much.
Right, takeaways. So Tesla have surged post-election. President Musk, now head of the Department of Government Efficiency, in a powerful role. Keep an eye on SpaceX, potentially IPO bound. Now that's going to be a cracker of an IPO. Consider cryptos like Coinbase, so the stocks relative to crypto that might thrive under those new crypto-friendly administration. The gold price dynamics have defied expectations despite economic shifts. So what's going to happen in that first 100 days with Ukraine and Russia? That is going to be critical. Peace deal might redefine commodities, benefiting companies like Ferexpo and Bank of Georgia. That's not one that we look at.
But Andrew McKelvey for Expo.
Exactly. Trump's victory may ease banking regulations, boosting stocks like JP Morgan and Goldman's, even as defense spending could be scrutinized. So Trump, of course, may have to cut defense spending or at least hold it while trying to talk Europe into increasing theirs. US-China trade hit records despite tensions, suggesting future opportunities for resource companies outside China. So an incredible work from Sahil there. Today's market measures. Let's look back at that one next week and remind you on Monday when the US is shut, remember, and we've got that inauguration about to take place. Now, speaking about important American things, Ange, what have you got coming up after the break?
Very important. More important than inauguration. We've got the one, the only JJ Kinahan, head of IG North America, coming up right after this. So stay where you are. Welcome to the exciting world of options trading. If you're looking to add a new dimension to your trading strategy, you're in the right place. Options trading offers unique benefits that can elevate your investing game. With options, you can protect your portfolio against market downturns, essentially creating an insurance policy for your investments. Now, what sets us apart is our commitment to your success. We provide extensive educational content to help you understand options trading inside and out. And with our 24-hour servicing, support is always just a call away. But that's not all. Options also allow you to generate income from your existing positions. Strategies like covered calls let you profit even when your stocks aren't making big moves. Options also shine when the market isn't following a clear direction, whether prices are rising, falling, or staying flat. There's always an option strategy you can use to potentially benefit. Now, we offer two ways to trade options: listed options for US shares, ETFs and futures, and over-the-counter options through spread bets and CFDs. Both types give you the ability to take various market positions. So, ready to explore the potential of options trading? Well, open an account today and take your first steps into this dynamic market. Remember, while options trading can be rewarding, it comes with risks. Always trade within your means and never risk more than you can afford to lose. Hey, trader friends, welcome back. And as promised, we have JJ Kinahan in the hot seat with us. He's, of course, the boss of IG North America. Thank you so much for joining us.
My pleasure. Happy to be here.
My-
The studio looks great.
Yeah, it's quite an impressive change. And also, we've extended the show since we last spoke to you. Another half hour. We've got series now. Tell us about all the key changes on the Tasty side. What's been happening over there?
Yeah, so, we've spent a lot of time on our platforms, and that's really one of two things we're really focused on, making it easier for people as they sign up for accounts on our platforms, because we really want to make the experience a great one, an even easier one overall. Our mobile device, we literally just put a big buy and sell button on for people there who just want to trade equities. And so what we're really trying to do is you can match the platform that you need at the time. What we found is a lot of our newer clients who are newer to the market use our mobile device. A lot of our more experienced clients use the Tasty Trade platform. And so it really is something that we want to make sure that the clients are having a fantastic experience wherever they are. They get whatever information they need at the time, because, you know, a lot of times I think when people are trading on the mobile devices, they're making a little bit of a faster decision. And of course, our web-based platform, which many of you hopefully here in the UK are using or are going to continue to use, we've made a lot of improvements. Hopefully you've noticed over the last 2 weeks. We had a release 2 nights ago in order to, again, simplify your experience, make it more intuitive for you. Look for a lot to change on that web experience that you're having every day, all for the better and all to make things a better experience for you. If you have any suggestions, feel free. jj@tastytrade.com. Email me. The way we find out how to make things better is when you're having an experience that you think could be improved or you really like, so we don't change it. Again, always happy to hear from anybody on ways that we can improve.
As AJ mentions, we always give you an answer. It may not be immediate if we're finding it, but we always get you an answer.
Well, we try to give it immediate. It may not always be the answer you want, but it will be very fast.
Here, they often are used to me going, you know, I'll get it to you as long as I run across to James Rutter, and I run across. We've got a really wide trading floor here, but we always try and get you the answer. Lots of positive feedback from many of our clients already using the Tasty platform, just showing you some of the key features here, but also they love the fact that IV rank is super easy to find, right? On the right-hand side. The dashboard is super easy to find. Lots of clever questions coming from our trader friends too who watch the show. JJ, maybe you can address that. They're kind of saying, how come we don't have the whole options universe? Just the liquid ones. At any point, are we going to add more?
Yeah, we'll always continue to add. You know, again, you want to. One of the things that we are very conscious of, and hopefully you're getting that from watching the show every day, watching how we talk about options, we want to make sure that you have the most liquid products. And so we always talk about liquidity being a major factor. I always want to be, as I say, the smallest fish in the largest pond. And the reason being because if everybody else is there, I know that the markets are really tight. I know, you know, not that this is a recommendation to trade there, but if you're somebody who's trading in the spider, you notice that every single market is a penny wide on both the underlying itself and the options all day, every day. And so the advantage that gives you is that you're not giving up money getting in and out. You want to trade things that are at theoretical value if you're trading spreads, etc., as much as possible. Remember, if you traded at theoretical value, which in general is the midpoint of the bid and ask, nobody has an advantage of you.
So let's pivot to the markets now,
Sure.
JJ. I mean, you know, like seeing this bit of a break before that key inflation number, right? Also, corporate earnings now firmly, you know, just around the corner. What is your call for the next coming hours?
Well, corporate earnings are a few hours away here. I think, you know, you guys right here in the UK had some nice inflation numbers this morning on the back of the inflation numbers we had yesterday in the US, which showed things weren't quite as bad. However, there is one thing in particular that I want to keep my eye on, and that's the price of crude oil. And so crude oil, as we speak right now, I believe was up a little bit this morning.
Oh, we are?
It is trading at about 76.
663.
Yeah. So up a bit. And so after 3 days in a row of higher prices in crude, it sold off a bit yesterday. But again, one thing I always keep my eye on in terms of inflation is crude oil. Why? Particularly in the US, but I think around the world, the first thing that hits your bank balance, if you will be the price of crude, filling up your car or traveling or whatever you may be doing. That's something that hits people really quickly right in the pocketbook. And so I always watch that one as an inflationary measure. The fact is it's been between about 72 and 80 for a while now. 80 is a key point where I would be very careful in terms of if we break. So JP, you know, we saw really good earnings. Actually, the unofficial kickoff of earnings was last week at Delta Airlines. Delta Airlines kicked us off on a nice note. However, today is the day everybody's looking at. You got JP, you got Wells Fargo, you have some of the big banks. And so one thing I want to keep in mind, JP Morgan tends to be the one that sets the tone for everybody else. They're such a giant bank. I believe they're the 5th largest bank in the world, certainly the largest U.S. bank. There's some Chinese banks I know that are bigger than that. And so with that, they are an incredible source for the U.S. markets overall. And what actually matters, I don't ever tell people to listen to earnings calls, et cetera, because most of them are long, and you know, unless you're really into it, you won't have as much interest. But if you look at the highlights of it, Jamie Dimon, who's the CEO of JP Morgan, is the dean of U.S. CEOs, and so his word goes a long way. Always interested to see what their view of the economy is coming up, where they see things heading. I think you want to pay attention there to what they're talking about in terms of interest rates, in terms of the housing market and how mortgages are going to be affected. You know, remember, now we're calling for 2 interest rate cuts this year, but many of the Fed governors, if you listen to their rhetoric over the last week and a half, et cetera, has been like, maybe we don't even need to cut rates, because we have seen, despite what we saw this week, we have seen inflationary pressures continue in the market. The U.S. had a healthy jobs report last week. That, again, is
Very
inflationary
healthy.
pressure.
I mean, we're always gobsmacked here, JJ, by how strong and resilient the U.S. jobs market is. You know, even you know, after COVID, even now, it just seems like the U.S. consumer just keeps spending.
Well, that's what it is, though, in terms of the jobs market. One of the things that I think you got to take with a little bit of grain of salt on that report is where jobs were created. And that is the fact that the leisure and hospitality index continues to be one of the leaders. That's not a terrible thing, but tending a bar or waiting a table, many of us have done it at some point in our life, but it tends not to be a career. And so for most people, that's why I'm a little bit shaky on that one. I want to look at things where we did create jobs. There was healthcare, which is fantastic overall, but where we didn't get them was, and we got government having higher jobs, but where we didn't get them was construction, transportation. Those are the areas that I think are much more important to be creating full-time jobs, because those tend to be longer-term careers.
So you're looking at core.
I really want to look.
Job creation.
The next level down is where are the jobs created, and when I look at where the jobs are created, I want to see careers being created, not jobs being created, and there is a difference. And again, this is not a rip on anybody. Hey, I've tended a bar and waited a table, and I'm sure you probably have, and most people watching.
Cal's Diner.
Yeah, again. And I think most people watching this have probably done it at one time or another. But again, the percentage of people who stay on and have that as a career is very small. So that is just something to take with a grain of salt.
And that's absolutely right. Highest turnover industry in the UK, I'm sure it's the same as the US, is the services.
Of course.
Yeah, business. Speaking of that, JJ, volatility index, and whacking that up for your trader friends, because we have seen this tick up, right? Both expected and realized volatility have begun to tick up 2025 at above average levels. Rich and I talk about this a lot. Rich has got a danger 25 level. Sahil has 18. We're going to tease him because we're like, oh, you're still young and untainted. I monitor this just so that I get a grip on how markets are feeling. Does this at all concern you?
No. It doesn't concern me yet. I will say this, 20, to Sahil's point, 20 is historically the level, but if you look over the last few years, 18 has actually been a little bit closer to what we've seen. And so with that, I think Rich is right to say 25 is, a highway to the danger zone, if you will, but a little Top Gun reference for those of you who like that movie. But that all said, anything below 20 doesn't concern me as much. Above 20 becomes more interesting, and above 25 is a little bit of a danger zone. What I like to look at when I look at the fixes, I like to look at it in terms of gold and also U.S. bonds. And there, so for the bonds /ZB on the future. And so the reason I like to do that is because to me they're the three musketeers of risk. If VIX is going higher, bonds are going higher, and gold is going higher, to me that's usually something that the market is signaling and saying, okay, we're looking for security. What we have seen in the bond market, both in the UK and in the US, is bonds just getting absolutely, I believe, gobsmacked is a term you use here in the UK. And so they have just been getting, beaten like a rented mule. There's no other better way to say what's been going on over the last few weeks to the bond market. A little bit little concerning and a little confusing in terms of the bond market perhaps getting out ahead of inflationary risk, because again, if bonds go down, rates go higher. Higher rates are what fights inflation.
We got a 45-second count to the hard out expectations
unfortunately, I had to
ahead
be somewhere. I apologize.
of that inauguration.
Well, if I knew exactly what was going to be happening, I would be on a yacht somewhere in the Virgin Islands. But that said, I think that the President Trump's inauguration here is going to add a little bit of excitement to the market overall. There's no question about it. Just look at the amount of CEOs, particularly in the tech and crypto space, who are trying to get into that inauguration and paying a lot of money to do so. So there does seem to be the fact that we are going to, I believe, have less regulation in the U.S. You saw it, right before the break. You guys just did a really nice segment on what happened last time. I think it's going to be really interesting to see the sectors that go up this time. And again, I think technology, the tariffs, or what tariffs happen, I think is going to be the most interesting thing to watch there. But don't discount some of the beaten up sectors recently. Like the healthcare sector last year, again, got beaten up pretty well. It's off to a pretty good start here in January. And so, for those of you who are contrarians, you look at the sectors that had a tough time last year and say, okay, is there opportunity there overall? And I think the last thing is AI and how it starts to affect us. I think 2025 is the year that all these companies have to really answer the question of, you spent billions of dollars, besides getting a real cool search, what else can I actually do with it, or play a game more intensely? So I think that AI is going to have to really answer to why we've spent all this money this year.
Thank you very much, JJ, and we look forward to welcoming you back.
All right, thank you for having me. Always great to be here.
Planning to make investing your New Year's resolution? IG Invest brings their trading expertise to a brand new, simple and user-friendly app. With zero commission on US stocks, why wait? Download IG Invest today.
Bring me the next shiny new thing. Bring me the next shiny new thing.
Hi, I'm Sean Mearson, Senior Market Analyst at IG, and join us for our new show, Charting Essentials. That's every fortnight on IG.com, our trading platform, as well as YouTube. And that's the show where we look at everything technical analysis, hoping to help you upskill. Whether you're starting out or just looking to level up, we got you covered. In each episode, we'll break down complex concepts into easy to understand lessons, provide practical tips to help you sharpen your chart reading abilities, explore powerful technical indicators and their real-world applications, as well as guide you through hands-on examples to reinforce your learning. So come, let's work on our skills. Let's get better at this. Let's accelerate that trading journey, learn to have confidence to trade, and make informed trading decisions.
Welcome to the exciting world of options trading. If you're looking to add a new dimension to your trading strategy, you're in the right place. Options trading offers unique benefits that can elevate your investing game. With options, you can protect your portfolio against market downturns, essentially creating an insurance policy for your investments. Now, what sets us apart is our commitment to your success. We provide extensive educational content to help you understand options trading inside and out. And with our 24-hour servicing, support is always just a call away. But that's not all. Options also allow you to generate income from your existing positions. Strategies like covered calls let you profit even when your stocks aren't making big moves. Options also shine when the market isn't following a clear direction, whether prices are rising, falling, or staying flat. There's always an option strategy you can use to potentially benefit. Now, we offer two ways to trade options: listed options for US shares, ETFs and futures, and over-the-counter options through spread bets and CFDs. Both types give you the ability to take various market positions. So, ready to explore the potential of options trading? Well, open an account today and take your first steps into this dynamic market. Remember, while options trading can be rewarding, it comes with risks. Always trade within your means and never risk more than you can afford to lose.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
Rise and shine with IG's new morning show, Trade Live with IG, covering all our UK product offerings, including our OTC and exciting new US listed products. Starting in September, join us every weekday from 7:30 to 10 a.m. for exclusive insights from our trade desk, expert trading concepts curated by our friends at tastylive, global guest appearances, and loads of viewer interaction. Regular platform feature highlights and up-to-the-minute market updates. From casual chit-chat to in-depth analysis, we've got your morning covered, live on IG.com, YouTube, and in IG's trading platform. Whether you're a seasoned professional or just starting out, there's something for everyone. Tune in, stay informed, and kickstart your trading day live with IG.
Hello and welcome back to Technically Speaking, where I'll be talking about some educational things first of all, and then we'll look at the trade of the week in a bit more detail and also at other charts. And I'm happy to look at your charts as well. So please send in your questions and I can then hopefully answer a few of those. What is fundamental analysis? And basically what fundamental analysis is all about, it's about value. And what it does, and I just quote here, is it's a process of evaluation determining the intrinsic value, that is to say the real worth of an asset by examining related economic, financial, and other qualitative and quantitative factors. So that's the definition. You can read it up on Google, etc. But what is it really? It's all about value. So what is value? Basically what a fundamental analyst does is that he or she will study the underlying value of an asset. Could be a company, for example, and a share of that company can be overvalued, it can be undervalued, or it can be at fair value. And that's basically what the analysts do when they look at a share, for example. What they do is they try to determine whether it's a buy, so they give it a buy rating, a hold, or a sell rating, and or variations thereof. But basically that's what analysts do, and those are fundamental ratings on, for example, a share of a company. And when these analysts analyze the company, what they look at is macroeconomic factors, obviously, which are influencing the company's share price, because a company could, for example, make more profits in an economic environment where there are more purchases of their goods taking place and things like that. So they will look at macroeconomic things like GDP, inflation, growth, fiscal and monetary policy, and things like that. But they also look at company-specific things such as, is the company growing? What are its profit margins? What are its debt levels? What does cash flow look like? EPS, earnings per share, the dividend yield of the company, and things like that. And then based on that, they try to assert where the future value of the company will be, and they then make their recommendation based on that. A very successful fundamental analyst is Warren Buffett. You might have heard of him, who is a value investor. So what he and his fund, Berkshire Hathaway, basically do is that they look at undervalued companies, which in the future, in a few years' time, will then hopefully make them a lot of money, because they bought the share price at a lower level and they found value in the company which other investors didn't find. Now, that's all very well. If you want to do a fundamental analysis, for example, on shares, you can do that by analyzing a company and we have these ratings on the IG website. You can look at that as well. But if you want to do it yourself, for example, on bond markets, what you would have to look at is interest rates, yields, the issuance of a bond. Is it the government? Is it a corporate bond? Ratings of that bond, things like that. If you wanted to do fundamental analysis on FX pairs, so foreign exchange market, you would look at interest rate differentials between different countries. You would look at things such as, for example, also purchasing power parity, and basically base your decisions on the big economic flows within these countries, whether one country is likely to outperform the other with regards to its interest rates and therefore also its currency, because a higher interest rate usually means that the currency that is linked to that is appreciating. You can also do fundamental analysis on things like companies, as I said earlier on, and share prices. The problem with fundamental analysis, in my view, is that it can get very complex and very complicated, and also you're looking at past data, which then quite often is revised. So you're looking at a lot of different variables, and these variables obviously give you all kinds of different outputs, and to then create a model which correctly forecasts what the future economy will do is quite complicated. And that's why I prefer technical analysis, where you just look at one variable and that's the price. And we'll talk about that next week. So after this long preamble, let's look at our trade of the week. And basically, we can see here the oil price, and we're trading against the trend. So why are we doing that? Well, quite often markets move in trends. And you can see here we've been trading sideways for a long time with regards to the oil price. And now we're heading higher, and we've broken through a long-term downtrend. So if you go onto the weekly chart, you can see here we drew a downtrend line from our highest point from March 2022 through then the next higher point, which was the June 2022 high. But that trend line here would have gone through these data points in the future. So what we've done, we've redrawn our trend line now so that no data points go through there except for the break that we're seeing at the moment. So what I'm saying is we take the highest point here and then drew our trend line through the July highs, which incidentally acted as resistance in October. And now on this weekly chart, last week we broke above the trend line and we closed above it. So that could indicate that we are forming a bullish reversal here, and that the oil price might go back towards $90 per barrel or so. But it's not just the trend line break which is important. What is also important is to break above the last relative high. As we all know, a relative high is for example, on this candlestick chart, a high which is higher than on its left and on its right. Now, since this is a weekly chart, the 7th of October high, that's the relative high, because the week before we had a lower high and the week after we had a lower high. So we would need to also break above this last relative high on a weekly chart closing basis, on a Friday basis, for us to confirm this bottoming formation. In which case we could then be heading back up again towards the April high of last year, around $87 or so. Now, why am I going short? Because as you can see here, we've got the October high coming in slightly above current levels. We've got the high from the end of August coming in at slightly higher levels. We've got the low of May, which we've just flirted with at the moment. And then we've got the high going back to August of 2024. So we've got quite a lot of areas where potentially this uptrend might short-term stall. Plus, as you can see here, we're currently testing the August 23 low, which acts as resistance. And we've got this whole resistance area here going back between January of, actually November of 2022, and also the highs in April 2023. So that is a lot of resistance potentially. That is not enough to go short against the trend, because we normally like to trade in the direction of the trend. But what I'm also seeing is, can you see the high we made on Friday and also today? Basically, if you look down here at our relative strength index, the RSI, you can see here that we're making a lower high on the RSI compared to the previous high. So this is lower than that one. Yet the market, the oil price, has made a higher high. This high is higher than this one here. So when you have that, this is called negative divergence because the market makes a new high, yet the oscillator makes a lower high. And when that happens, you've got a pretty high probability of, at least in the short term, over the next day or two or so, to see some sort of loss of upside momentum and perhaps also a reversal short term in the trend. And for that reason, and the previous resistance area I told you about, I believe that there is a pretty high probability that we might, at least in the short term, give back some of these recent gains and perhaps come back down again slightly. Now, how far can we go? Well, what we do, we look to the left of our chart and we look at the lower levels, below the levels we're trading at the moment. Where do we find support? Well, we find this high here from the 10th of October at 75.70. That could be potential support, but it's just one level. If we go further down, can you see here, we've got the high from September of 2024, we've got the high from October of 2024, and we've got the high from November of 2024, and we've got the low from early January, all of which comes in around the $72.50, $73 mark. So that is potentially really, really good support. But it might not go all the way down there because now we've broken through our long-term downtrend. So maybe sometimes what happens is the market comes back, retests the trend line, the broken trend line, and then advances again. So I'm still medium-term bullish because the trend from the December low is bullish, but short-term I think we may give back some of our recent gains and perhaps retest either the 74 area where our broken trend line comes in, or the 73 area down here where all the previous highs and lows come in. So this is how you build up a trade, and this is what we're looking at. And what we try to do is make sure that if we are wrong, we lose relatively little money. So for trade of the week, we risk 2% of capital, as you probably know already. And our stop loss is above these previous highs. So we put our stop loss at 79.10, and we are short from current levels. And hopefully, for our trade at least, the oil price is coming back down again. So this is how we build up a trade. And I hope I've explained how I look at markets and what I look out for. And please send me some questions. I've just looked at them here on my screen. I hope the gallery can send me some questions through. And until I get those, let me just see whether I've got those or not. I haven't yet. Okay, if you have any questions, if you want me to talk about your charts and analyze those, please send them through to us, and we will have a look at them and answer your questions. Since I haven't got one at the moment, let's just look at other markets which are really, really interesting at the moment, and that is the NASDAQ 100, because you can see here the NASDAQ 100 is basically trading through key support here. You can see we fell through the low we saw earlier earlier last week, earlier in the month, and we are now, it looks as if we're now heading down towards these lows here. And we can see that, let me just try and move my chart up again, that we're heading back down to this previous low. We're testing that on these previous highs. So potentially we may hold around the 20,500 area here. As you can see, we've got these previous highs and this low coming together. But we'll have to see whether we can hold there or not, and very much will depend on the inflation number, the CPI number, which comes out later this week. But look at the NASDAQ 100. This looks really, really interesting at the moment. Another interesting market to look at is the US dollar index, or the US dollar basket. As you can see here, we are on track currently for our 6th straight day of gains. And if I go from my weekly chart here, and zoom out, you can see that the next upside target is this relative high here. That takes us back to around 110. So that looks pretty likely. And what is the inverse of the euro strengthening? Well, the US dollar strengthening, obviously, it's the euro falling. And as you can see here, the euro continues to slide on the daily chart and is heading towards parity. So really downside to be seen in the euro. In the British pound against the US dollar, as you can see here, we're very quickly approaching our low from last year, and you can see that that was made down here around the 102 area. So we've got these round numbers, parity, 102, all of these attract these currency pairs at the moment. I've got a question now. Monkey Man asked me a question. Thank you very much. And the question is, which is more important? What should you take more notice of, the trend line break or the support levels? That's a very good question. And basically, what it is that a trend line break in itself, if you close through the trend line and close above it, so if you look at the daily chart, for example, and you have a trend line break above, or you have let's say you have an uptrend, you have a trend line break through the trend line to the downside, and you close below it, that's the first indication the trend could change. But most of the time what happens is you've got your trend, which is pointing up, and then it just becomes flatter as the momentum of the uptrend weakens. So that happens very often, which is why you also need to look not just at the trend line break, but more importantly at the last relative, in this case, the last relative low. If you fall through there, then it's more likely that you see a trend reversal. So I would look at these support and resistance levels, the important ones, which are, in my opinion, more important than the trend line break. And also be very careful if there's a trend line break just intraday, it doesn't mean anything. And a lot of people try to trade the trend line break. And yes, sometimes it looks great, but quite often they will just go through the trend line and then come back towards, and you have to redraw your trend line and flatten it a bit. So let's look at another question I've got here from another person, which is the S&P 500. Let me just put this up here. That's the last one we're going to look at now. The S&P. What does the S&P look like? And you can see here the S&P is similar to the Nasdaq in that it's currently, I mean, the market's not open yet officially in the US, but it's fallen through the previous relative low. That is bearish short term and may well mean that we're heading back down again towards these lows here at around 5,700. Now, it may hold though, because we've got this support level down here and these highs here. But we'll have to see what happens today, whether we can, on the daily chart closing basis, hold above this area here and bounce back. But right now, it looks as if we're breaking through this support, and we may be heading back down again towards the 5,700 area. And you can see that this whole area here acted at really, really strong support, and it also coincides with this 5,650 area, these previous highs here. So that's a really important technical support area. And we may be heading back down again towards that. Very much will depend on the inflation data out later on this week. And thank you very much for watching Technically Speaking with me today.
Stocks staged a comeback of sorts. It's Tuesday, January 14th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan in an asylum. We'll be here for the next hour as we take you through the futures close. If you're joining us on the platform on tastylive.com, come over to YouTube. Tell us what you're trading today. If you're already in the chat, come over to tastylive.com, see what we're all about. A day that started with a bit of a bang. The PPI report came in softer than anticipated. Stocks, bonds exploded, relatively speaking, after that 8:30 a.m. Eastern print, and then gave up the gains the rest of the day. It was a slow grind to the downside up until about 3:30 p.m. Eastern, and then we decided to turn things around. So as we turn to the charts, we have an S&P 500 that's actually up by 0.3% today, 5882 and a quarter. The Nasdaq up by 0.15%. It's the Russell 2000 that emerges as the top dog, 1.35% higher here. Perhaps surprisingly, Ilya, because bonds did not respond positively to PPI well at all. Why isn't the market responding in a way that it should when it gets the information it would want to see to move higher?
It sort of did if you look at for about 15 minutes of S&P 500 price action. So the numbers came out, the S&P 500 popped. ever so briefly, and that was that. So you can see that big green candle right there. That's the PPI data set, and it ultimately didn't do anything. You have a similar thing in ZB at exactly the same time. You have a similar thing in the dollar, whether you want to look at DXY or the euro. There's that long wick right there. So you see them respond. They just don't ultimately do anything with the information. And I would argue it's because there is a much bigger event risk directly in front. The Fed does not target PPI, and there's not a direct read-through from PPI to CPI necessarily. People are usually tempted to say, oh, well, this is, if you get a rise in PPI, surely that there's pass-through from wholesalers to consumers, but it's not always on the same cadence, and it's not always in full, and sometimes wholesalers opt to eat the price difference. So it's not always a straightforward thing. And of course, over the next 24 hours, we're going to get CPI, which is a much more Fed relevant number. And that's really where I think the market looked at and said, yeah, before we do anything, before we show any kind of directional conviction, we want this other number. And your audio is gone.
Sorry, we're waiting to pull up the charts here. Dylan, tomorrow's inflation report, is that really what matters? I couldn't help but notice earlier today, as I set the stage for this, VIX one-day is now closing in at 22.78. I want to provide some context here for this. This is the highest VIX one-day that you've had on a closing basis heading into a CPI report going back to 2023 earlier in the year. It's higher than any one VIX one-day reading that we've seen at any point in 2024. By all accounts, the market's telling us tomorrow's CPI report matters more than any CPI report last year.
Yeah, no. Trump is going to be the thing from here on out. I mean, certainly from now. I mean, relative, unless it's a really wild set of numbers, obviously, the CPI probably matters more than anything else that could matter other than a jobs number, for the reasons that we've talked about ad nauseum about Trump's inflationary nature by virtue of his existence and the sort of preconditioning of the markets in general. But I still think, and I think you kind of hit it on the head when you said, even when there was data that should be as good as we can be in terms of good data, the market still was like, I just don't think that the market is being driven by macroeconomic traditionalism at the moment, insofar as it's way outside of expectation. So unless the CPI is meaningfully way off one way or the other from expectations, I would think that it's actually going to be relatively modest in its relevance, even though it probably should be more relevant considering the more relatively inflationary nature of the world in the first quarter than some people might have anticipated. But the Trump tariffs are coming next week, at least rhetorically. And there's just going to be a whole nother, I think there's a lot of, you're going to get about to have a president. You're about to go from a president who never appears in public and it barely ever speaks in any way, shape, or form, to a president who's going to be talking all day, every day for 4 years. And it's certainly, that's going to take a moment to get used to. And next week will be part of a big week for the getting used to it, which I just think is why the market's relatively neutral. I'm encouraged by the strong bond, which I know you got that up here. You know, I think that that's the most interesting thing that happened today.
There is a late-day rebound.
Yeah. No, I actually nibbled a little. I bought a little TLT call vertical here. It's very risk defined. It has, frankly, excellent risk reward based on the way this volatility is priced. At this point, it's something on the order of like 3.6 to 1. So very good opportunity. If you're wrong by not that much, hopefully. And if you're right, you can get asymmetric opportunity. So I picked up a little bit today, essentially thinking that CPI is not going to tell us anything that's going to get the Fed pulled into an even more hawkish direction, considering how much we've already been pulled. Markets might have a harder time at this point, concluding that there's going to be no cuts at all. I can see them sort of coming around to the idea that there's one, but none is probably tough sledding without much more evidence from the Fed itself. And so I think at this stage, maybe there's opportunity there. I've obviously been long the euro as well, much too early, but I'm sniffing around adding into that position because that actually gives me a little bit more confidence today on the bonds side as well. It looks like the whole kind of long dollar, long yields thing may be running out of juice.
Ilya, I couldn't help but notice this market has really flattened out those Fed cut odds. The SR3 Z5 contract is currently trading in at 95.915. The SR3 Z6 contract is trading in at 95.80. Right? You're talking about potential for what? One cut now effectively priced in through the end of not just this year, next year. That's saying that we're going to get, a perfect world where we've now seen the neutral rate move up, that the Fed is hamstrung perhaps by fiscal policy. I mean, what is the market telling us here that the rest of us are missing? One cut through the next 24 months is a light load that screams inflation is back.
I mean, Fed funds futures are a little bit heavier, and that might be the difference between 1 month Fed funds versus 3 month SOFR. There might be just a little bit of a underlying difference there. But if you look at 1 month Fed funds, you're looking at it looks like 29 basis points for this year, 19 basis points for next year. So you got to cut a piece if you look at those readings. But in any sort of way you slice it, any which instrument you want to use, you're looking at a situation where there's clearly a massive readjustment from what not only the Fed told us in September, obviously they've backed off that themselves, but even what the Fed told us in December. I mean, we can see from this SR3Z6 that you have on the screen here, it was moving meaningfully into a more hawkish direction going into the Fed announcement. But of course, there's the start of 2025 there. It's moved more even since, with that sharp move, of course, on Friday, marked by NFP. So I think as we look at what's going on there, I mean, clearly the market is of a mind that hot ISM, hot NFP, hot consumer confidence numbers, all of that means the Fed's hands are tied.
Fed's hands are tied. Dylan, I think you're right about this market being fixated on Trump right now.
Right. You got a president madman come crazy pants. President Crazy Pants is about to take the microphone. Like, you got to calm down and wait to see what happens. I mean, unless there's some real outliers. I guess the interesting thing, just from a trading perspective, is the degree to which the bond is finally put in a bottom, and as to Ilya's point, signaling that. That's a real thing. And the degree to which the tariffs are a real thing.
Whether or not they're going to materialize right away, my own headcanon is that we're probably going to see tariffs within the first week. I was looking to see if there was betting markets on this, and of course there are. Will Trump oppose tariffs in the first 48 hours? Basically a 1 in 3 shot, a little bit better than that for Mexico and China, just under that for Canada right now. I think that's what we're all waiting on, right? Like, let's see, is this all just for negotiating ploy, or is he really, a president from the late 19th century? And the bond market seems fixated on that. So I'm having trouble crossing this bridge, right? We have a VIX one day that's telling us This is one of the more important CPI reports that we've seen in recent years. But of course, we have a market today that gets a PPI release that you would think it would respond a little bit more positively to. And it does absolutely nothing with it and gives up the goose. Maybe it's because it's coming before CPI that it doesn't have much staying power, and I certainly understand that. But we've also seen PPI reports push the market around much more ahead of CPI over the past 12 months. So certainly a fascinating day from the price action standpoint. Ilya, has anything changed here technically for those traders who are looking for any sort of clarity on whether or not this is a top or a continuation pattern?
I think if you're bearish, you liked what you saw today because there was an attempt to retest the underside of the range that we broke on Friday, and there was a very clear-cut rejection there. But I don't think you can really make hay of it because you still have the event risk. So the structure here, at the very least, told you the market is not prepared to make a run higher on the basis of nothing other than it's had a pullback. So if you were of the mindset that the Fed doesn't matter and rates don't matter and the market does what it does and people are foolish to even pay attention to these things and everything is already pre-decided, the market dictates to the Fed what to do, blah, blah, blah. If you thought that, well, then today's price action told you that you're wrong. Because if that was true, and if you should buy the dip every time, well, nothing upset the markets in a pointed fashion today. Nothing was different, and could they manage? No.
Yeah, we're not. It doesn't feel like we're quite out of the woods just yet. The Russell's late day turnaround should be watched. I'm trying to figure out if this is a false breakdown now out of a potential bear flag. I know that you recently squared out your position, Ilya. You were short up until about yesterday, and in hindsight, obviously, a good decision. That sharp bounce off that 200-day moving average, we're now about 2.5% above it. So it has been a fairly sharp turn here. I'm looking to see if we can break the relative downtrend that has guided price action for 2025 right now, because if we continue to push higher through here, quite frankly, if tomorrow we find ourselves trading through the highs of today after CPI, you start to see this bear flag as having been broken. And
it's going to start to look very different.
Yeah, right. All of a sudden, this bearish engulfing bar that you had around the non-farm payrolls report last week on that 4-hour time frame, that high is 2252.80. You're on the other side of now. It looks like
that's what you got to clear for me.
Yeah, you got to look at a bounce
back
then.
Through those former lows. You got to essentially get back into what would have been the middle of the flag, give or take, and then you've basically undone it, and then it's a whole other thing.
It's a whole other thing, though, but it doesn't necessarily mean that this is the bottom for the near-term congestion. It probably just means that we're due for the typical type of price action that defines Q1s in recent years, which is just for a lot of chop up until the middle of March. And if you were to get a market that breaks through 2250 here, Dylan, you open up the door towards 2300, 2320, and it still doesn't mean that you feel confident for anything much more than that in the short term. Same thing for the S&P. I mean, it would be a bounce back perhaps into the 6,000 neighborhood, but does that mean that we're outside of the downtrend? Does that mean we're outside of this potential head and shoulders pattern? The answer is no. So this week feels like a really frustrating week for a lot. I have not placed a single trade in any equities thus far this year. Why not buy the
bond? I guess my only question, I understand on the equity side, but Becky, why not buy a bond for a friend?
Am I buying it as a trade or an investment?
A trade.
No, I couldn't, I couldn't do that right now.
Couldn't do it.
I wish I could help you, sir, but alas, my hands are tied.
Yeah. No, look, someone pointed this out in the chat a while back. Like, they were quipping about that I had a pretty good year. And someone said back to them, like, well, he's a momentum trader. It's a momentum market, right? Like, I buy when things are going up and I try to sell when things are going down. So from that perspective, is this a chart that I would want to buy on a momentum basis? That being like the glove that fits me. And the answer is no. Like the defining characteristic of this market over the past few weeks, if I like to overlay this EMA envelope for people at home, We haven't seen a close on the other side of the 8 EMA. What amount of time is that? Doesn't really matter. It just goes up the Fibonacci scale. But we haven't seen a close on the other side of that 8 EMA since December 9th. And every time we've run up into it on an intraday basis, we've sold off. So the momentum is clearly very negative right now. I get the volatility being high, 50 IVR is very alluring, but this is the proverbial catch the falling knife. I suppose if you wanted to look at the continuous contract and go to the weekly chart and look at those swing lows from last April, we have plunged through them. So this is kind of a no man's land for me. We could easily wash out back down to 108 as we are to recover back to 113. So probabilistically, I see no reason to get long here right now. But if it was an investment, if you said, hey, Chris, are you willing to hold this, TLT for an extended period of time, the next 6 months or a year, how could you not look at 5% yields on the 30 and find that to be something interesting to lock in? So time horizon really matters.
Go to a 4-hour chart here, because I think what you start to see when you get into the immediate structure of the past, let's call it couple of days, what you're starting to see is today you get a long wick on the second to last candle before the close. It fails to make a new low. You see positive divergence on the oscillators, and then the last 4-hour candle of the day ends up erasing the last red one. And so you get a narrowly higher high. So, and a closing high. So when you look at that, it's not a lot to go on. It's a pure momentum kind of a thing. You tried to break the bottom of the range and then failed, and then reversed back into the range with momentum fading. So that's the kind of thing that I look at and go, it might be wrong, but it's the kind of thing that gets you risk reward that's attractive if you can structure the pricing. And that's why, rather than, let's say, buying a call, I went the vertical route. I wanted to make sure I keep my risk very contained so that this thing does not run away on me, because it's a flimsy signal, but it's the kind of thing you'd look for in the very, very early innings of a turn.
I would rather wait for 112 in ZB than buy down here at 111, just for the sake of seeing some downtrend break. But it feels like so much of the conversation around bonds is really just a conversation about oil. And I know we fixated on it and whether or not it's topping up near 78 or 80, depending upon what time frame, or rather what expiry you're looking at. The H5 has highs closer to 79. If you go back to G5, it's going to be closer to 80. I was looking at the correlations today between bonds and oil prices in recent weeks. I couldn't help but notice something here. If we look at the correlation between crude and bonds right now, the rolling 1-week correlation for coming into today is negative 0.98. At the start of the year, it was we closed last year at negative 0.01. If we were to look at this on a 1-month basis right now, and I need to just change my input here just a second. If we were looking at this on a 1-month basis, the correlation between CL and ZB is now negative 0.79. At the start of the year, we entered 2025 at negative 0.66. So bonds and oil have really, really tightened up right now. And as you can imagine, the correlations between oil and stocks and then bonds and stocks are in the same neighborhood. The market seems to be responding to higher oil prices. So it feels like if I want to bet on bonds going up, I'm basically betting on oil cooling off here. So are we going to take that stab, Dylan, fabled oil trader, tastylive?
Come on. First of all, the nice thing about the bond is that the bond is a very clean, very liquid price on inflation and growth expectations, both of which are very dynamic right now, and both of which have a lot of new information that will affect those expectations over the next few weeks, which is nice. Oil, similar in its liquidity and accessibility to this new information, but is compounded by its commodity currency inflation offset and geopolitical, canary in the coal mine that makes the oil price an act of madness. I mean, if anything, the oil price is either predicting a much stronger 25 than anything else. I suppose the bond. So the bond and oil basically saying inflation and growth are hot. Inflation's too hot and growth is stronger than you think. I mean, because the other thing to do, instead of trying to trade against oil or with the bond, is to accept that the bond and oil are correctly telling you that inflation risk and growth probabilities are both higher than you might think.
Ilya, assuming we want to get long, you say that you're structuring it through long call spreads. Are they in the money, out of the money? They're at the money. Like, what are you doing here? Are you
at the money? A little bit better. I think so. I'm doing this through TLT first of all, just to keep size contained and make sure that my risk management is sensible. Certainly not doing full ZB contracts. And looking at the way I've structured it in TLT, I have a call vertical from 85. So in the money, the market was at 85, I think 11 when I put this in. So I paid a little bit to start in the money, but only a bit. And the risk reward on this ends up being something like 3.6, 3.7 to 1 with an outward target at 94. That's the top of the spread. So we'll see. 94 on TLT, if we want to talk about this in ZB terms, would amount to basically getting back to the early December high. So the swing top of the last kind of leg lower back to like December 6th on TLT, that would be just around the 120 figure. So that's a pretty sizable move. If you want it to be modest, and instead of aiming for something like 94, aim for 90. So the underside. So not assume that you're going to take out former support, now resistance around there. The trade can be cheaper still. Now, of course, that's sort of theoretical at this point because you're going to get CPI out before you can do anything in TLT now because, of course, U.S. equities are closed. So if you're going to do anything with this now, you have to go to the futures market. You have to look at ostensibly, if you want it to be small, you'd have to look at the 10-year rate future. That would be the sort of the micro exposure there. You'd have to look at that and basically short that with a put vertical. The liquidity there is going to be a bit
teeny tiny,
a bit challenging. Yeah. So if you want to lay this on overnight, you might have to stay up into the London Open when some more liquidity comes in and hope for the best. The other way that you could express this same idea, if you didn't want to do that and do it through the bonds, would be just to buy some euros.
Ew.
Usually have sales specials where they're about 6.
Why would we ever want to do something like that?
Well, take a look at what 6E did today. And I think what you find there is basically the other side of this story. So here, much like
what got a 1% move the other way?
Basically.
Yeah, so
which is not nothing for currency.
No, in fact, quite a lot for the most liquid of the currency pairs. Euro USD exchange rate is the most liquid financial instrument in the known universe, as far as I can make out.
Can I share something here? FX exploded last year. I was looking through this report. CLARusFT.com. They do he runs a pretty good blog on various machinations in the currency market. I might as well just pull this up here. This particular blog by Chris Barnes is about the growth of cross-currency swaps in the market. But in terms of 2024 for FX, generally speaking, First quarter, second quarter, third quarter, each quarter saw over $1.6 trillion in trading volume. The fourth quarter nearly saw $2 trillion in trading volume. We peaked more than $7 trillion in FX volume last year. Eurodollar saw an 18% increase in growth overall, a 23% rise in trade counts year on year. Yen dollar saw a 43% increase in volume, which I don't think surprises anyone given what happened mid-year. Aussie dollar, 17% increase in volume. The only thing that did not see an increase in volume was the British pound, which, is becoming a backwater currency. But FX markets right now, these are super deep and super liquid. So the fact that you're getting a 1% move, that's not a small amount of money that's making its way through the system, is my point.
Yeah. I mean, and by the way, when we're talking about the volumes coming through FX markets, I mean, we're talking about what, 5 trillion plus daily turnover kind of market. I don't remember the last time I looked at the aggregate numbers in the BIS report. I usually just look at the share of transactions bit, where I look at how much each currency comprises of overall turnover. But I think we're looking at north of 5 trillion in turnover, and that's the 2022 survey from BIS. They're going to update it this year. They do it every 3 years. So
yeah, the triennial survey.
Yeah, so 2025 is an update year. We'll see how the totals stack up. But the kind of volume transacted in these markets makes all of the world's equities put together look like a drop in the ocean. So there's tremendous volume here. Liquidity on liquidity on liquidity. And of course there is. We're talking about cash.
Yeah, as of 2022, in terms of global turnover, obviously the US dollar is in most transactions, but then the euro is up there as well.
De-dollarization, folks. 88.5% of global monetary transactions are settled in dollars. We're de-dollarizing. What a bunch of nonsense.
We're really de-euroizing. The share of euro transactions has gone down and probably getting worse post-Russia sanctions. But Dylan, what's the view from Europe right now as our resident Italian here?
I think it's sort of optimistic for growth, which they will not find, meaning that there's sort of a hope that the nadir is in France and Germany, and that there'll be growth coming there after years of misery, which is unlikely. And then the bizarreness of having Italy be the strongest and most organized economy in Europe is alarming. And so I think that the basic hope here is that there'll be actual growth in the United States. I think that there's a greater sense of vulnerability to the United States than there has ever been because of the absence of domestic growth in Europe, the broken relationships east with Russia, regardless of what deal gets made, Brexit, all of these things make them more U.S. dependent at a time when U.S. rhetoric is not necessarily Euro allied.
It hasn't been friendly. European equities actually have a pretty good day today, up by 0.97%. Ilya, we have UK inflation coming out tomorrow morning as well. It feels like the pound is on an island here. Their stock indexes were down last year. The FTSE had a pretty crummy year. The pound does recover today, but I suppose not nearly as much as some of the other currencies. The euro's up by 0.97%. The Aussie's up by 0.6%. This kind of feels like the sick man of Europe right now.
Yeah.
Do we fade any rallies?
You've hit the nail on the head. The problem in the UK is the economy is slowing, which should, one would think, unravel the parts of inflation that are still sticky, because mainly the things holding up prices at this point are discretionary, hospitality mainly, and recreation. And when you look at those things, you'd think, oh, well, the economy is slowing and has been slowing for several months straight. If you look at the PMI numbers, surely this needs to be a positive thing, because it will unravel some of this discretionary spending dependent inflation, and the Bank of England can more readily cut rates to boost the economy. Well, no such luck. the inflation isn't unraveling, even as the economy is slowing, arguably for the same reasons that service sector inflation is not unraveling in the US, because it is baked into labor markets. And that is not an easy adjustment to force through. So when you have a situation here now where this might sort of speak to more structural issues downwind for a lot of economies. You've hired a bunch of people during the COVID years. You paid them the please, please, please come back to work, though it's early in the reopening sort of wage premium. But now there's shortages of labor because of demographics, and you can only afford to adjust that so much. You can't exactly go on a giant economy-wide layoff and rehire spree in every industry. Well, obviously, we've seen some of that in finance. We've seen some of that in tech, in fact, in tech with gusto. But it looks like some of these more human-facing industries just cannot afford to do those things. And so we've seen inflation stuck there, not just in the UK, but elsewhere. And so the UK has had this weird issue. At least in the US, we have strong growth to counter. And so it makes sense that the central bank is kind of backing off a little bit its more dovish tendencies. In the UK, you need rate cuts, but you don't have the inflation dynamics to get them. And so you have this ugly situation where the economy needs help and the central bank can't give it. Really, what we're looking for is for these inflation numbers to finally roll over. Otherwise, why would capital, and this goes to what you said about UK stocks last year, why would capital be in pound-denominated assets when demand is flagging in that space and the central bank has its hands tied to try to improve that situation in earnest?
Yeah, I mean, it feels like we really need to see something break, right? I mean, Dylan, I feel like you talk about, the Mad King, but it was Trump in January 17 who stopped the dollar's rally when the Trump trade was reinflating everything. But for his comments back then, the dollar probably keeps going. He wants to have his cake and eat it too. He wants to have a world where tariffs are high, but the dollar's weaker. So I think for me, and I look at the broader dollar index and I look at what's happening with the currencies right now, I'm kind of waiting for that shoe to drop. Is that just the risk for next week?
Which the shoe where Trump talks the dollar down?
Absolutely. I feel like we need that as a catalyst in the short term before we can finally get on board with the dollar really rolling over. Because tariffs themselves are dollar positive, are they not, Ilya?
Yeah. I mean, when you look at what's happening right here, the Fed is expected to what, maybe cut once this year? Well, let's leave next year out of it. Who knows what they're going to do next year? They're still trying to figure out what they're going to do in the next quarter. So let's say this year they cut once. Bank of England is expected to cut at least twice, looking at their benchmark interest rate futures, 1 month SONIA contracts. So there should be a dollar yield advantage here. But what we've seen is that UK yields have actually surged because, of course, when US yields surge, yields everywhere surge. We just saw how ubiquitous the dollar is. So when you increase the cost of borrowing dollars, you increase the cost of borrowing, full stop, in any currency, everywhere. And so when you look at what's been going on, it's sort of the worst of all possible worlds. The pound has been falling as local yields have been rallying because they've been rallying for reasons that have nothing to do with the UK. So what you really need, ostensibly, is for the dollar to give if the pound is going to do anything. And I'm thinking about being long the pound. I'm not there yet. But if the dollar is topping, that will be a move onto itself. It will also, in a kind of in a kind of strange way, bail the Bank of England out.
Why do you say that?
If U.S. yields start to come off, then the Bank of England can cut without fighting the Fed. And that could be helpful as a view onto not the pound, but UK stocks.
I mean, what if I want
give a bit of relief there?
Is there basically a trade just to be short the UK in 2025
for the rest of time?
Yeah, like just like like the cake is baked, let's stick the fork in it. Like now, it's just it's gonna fade away.
You can buy an EWU put with a super long expiry.
And is that better than short pound, or are you better off short the pound?
I don't think you're better off short the pound at all, because I think you're in a situation here where the pound is more reflective of what the dollar is doing in relative terms than it is of the pound. I don't think the pound is falling because of UK situations. I think everything against the dollar has been falling since mid-September.
How are UK gilt yields at their highest level since 1998, unless it's a UK situation as well?
But that's the whole thing, is you're looking at those yields everywhere. Everywhere has seen a rise in yields, except for China, which doesn't have a free market for these things.
Okay, so what if the drop in Chinese yields and the rise in Western yields is the same story?
I doubt it. But okay.
What if China, instead of recirculating our trade deficits back into U.S. government bonds, is taking the money and circulating it domestically because of the deflation that they're facing?
They can't. The whole process of the recycling of dollars is they get paid dollars, then they, without converting them back into local currency, recycle them into holdings of government bonds. It's a dollar recycling scheme. If you're going to repatriate the dollars back to China, then you're going to have to sell dollars. And that's not what's going on. The dollar has been rallying.
Yes, but if they've previously announced that they're no longer net buyers of U.S. Treasuries. They did that like a decade ago. So if they're no longer net buyers of U.S. Treasuries and all they're doing is basically recycling money back into Treasuries, and our trade with them is dropping, don't they have less of a reason to buy Treasuries?
I mean, one would think there's less volume there necessarily if the trade with them is falling. And to your point, they're no longer the largest trading partner for the U.S. Mexico is. And that's as of 2022. So sure, there is that, but how much of a driver is that? I mean, this is a decades-old story, but it's a multi-year shift in dynamics. I mean, really, they've lost a ton of market share since COVID. So for a few years now, that has been that. But we clearly see that the bonds are responding to the Fed. I mean, look at what happened in 2022. So it's not exactly lining up here. Now, maybe you could make the argument that it's reaching critical mass, but foreign ownership of U.S. Treasuries is relatively small compared to domestic ownership. So to say that China is the biggest holder, the biggest external holder of U.S. debt, that's one thing. But compare external holdings to domestic holdings, and domestic holdings are much, 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 much larger. So can the external space really impact what treasuries do unless, let's say, China decides they're going to sell their entire book at the same time, which they're not going to do because that would be suicide for them? No, not really. Not in sort of big long-term ways, anyway.
Mm-hmm. China's debt to GDP ratio is about 90% right now. By 2027, it's forecast to exceed 100%. You know, the economy is slowing, it's maturing, the demographics are terrible. I'm trying to I'm trying to figure out why treasuries aren't behaving the way that a lot of historical models would suggest they would, right? And there's clearly a gap here. I don't know the answer. I'm trying to figure it out.
I just don't believe that their bond market can be relied on to have the kind of liquid and two-way dynamics that our bond market would be expected to have. I think Chinese stock markets are thin, and the participation in them is, let us say, prone to hurting. And when you look at their bond market, it's not much better. So I just don't look at Chinese bonds as something that I would expect to have normal dynamics. I would compare them with normal, quote unquote normal, right? Because U.S. bond dynamics are not normal. They're reflective of a country with the global reserve currency, with the global, more importantly, transactional currency. Forget reserves. The most important thing for the dollar isn't that central banks hold it in reserve. It's that it is the vehicle for the lion's share of transactional commerce.
Well, you have 4 out of 5 transactions for any good or service on Earth.
Right. And it's gotten to a point where if I am non-US country A transacting with non-US country B, it is cheaper for me to trade my currency for dollars and dollars for the currency of country B than just to go from A to B.
Well, then why not just stay short the euro? Why not give it up and let the euro go break parity? Euro's going to 90 cents.
Because I don't think the timing is right. I think the upswell in the dollar has been about the Fed looking like they would be more reluctant to cut than they themselves said in September. And that was the move in yields. That was the move in bonds. That was the move in the dollar. And I think that story is out of juice. Because if the Fed is telling you we're going to cut 50 basis points this year and next, and the market is sitting at half that, I think just from a tactical perspective, the only way to get more hawkish is to say no cuts. And everything we've heard from the Fed suggests that is not what they want to do.
You know what's interesting? When we look at the 10-year yield, the day that it breaks out of the downtrend that it's in, going back to the October 23 highs or the lows in ZNZB, is the day of the December Fed meeting. What day do stocks break down and they haven't been able to climb back to those levels? The FOMC meeting in December, right? Sure. I mean, this is the story right now. The equity market is buckling under the weight of higher yields. I don't know if it's higher for longer to the degree that the markets. First off, I fundamentally and philosophically disagree with Tom's premise that there's like an efficient market hypothesis that's valid. Markets are priced efficiently insofar as you're going to get tight bid-ask spreads. But we look at history and we see that the market's projection for where the Fed funds rate will be 12 months in the future at any given point in time is almost uniformly always wrong.
Well,
right?
And they strive toward efficiency, much like the world strives toward freer trade sometimes and global
fairness,
peace sometimes. They just never get there.
But isn't efficiency ultimately about the value of the value and understanding of present information? I mean, of course, future pricing is going to become impossible.
So I think
sure.
To Chris's point, right? People say, well, to what extent do markets discount everything? And then they talk themselves into a thing where if the market is at level X, then obviously everything is discounted. You no longer have to think about anything at all. And obviously that to me is
not
completely wrong.
Not true.
Yeah, but like as someone who uses technical analysis, I literally can't believe in the efficient market hypothesis.
In its absolute form. I mean, you would agree that markets discount things.
No, but not even weak form. Weak form efficient market hypothesis says that public information is useful, private information is useful, fundamental analysis is useful, but technical analysis is useless. So like first right off the bat, as someone who looks to charts, I just don't believe in it. But the point is that you see like the breakout begin back in December, and ever since then, stocks have been struggling. I don't know if it's that we need lower rates, but the idea that we now have to entertain a possible world where interest rates could go back up means that there's a lot of uncertainty moving forward. So Dylan, it's Tuesday. It's not quite Wednesday. It's not time for truth or skepticism. We only have a few minutes left. But what grinds your gears right now as you think about this market as we wind into the next few weeks? We're making our way through the middle half of January here. So the first half of the first month of the year is almost over. What's really grinding your gears right now?
So it's interesting you asked me that question.
Please don't say to me.
Can I text you a picture?
Yes.
There you go. All right, so I just texted this thing to you. Do you get that?
Yes.
Can you publish that for the people to see?
I can if you give me a minute, if you start talking.
Okay. So the thing that really grinds my gears, as they say, Chris, is that there's a portrayal, a self-interested portrayal, but the motivations are less relevant. There's a portrayal of the incoming president of having achieved that position by virtue of a mandate of sorts, a resounding victory, a glorious validation of all that the new president represents. And I believe that I know for a fact that that's a massive misrepresentation of reality that's being used to manipulate a set of policies that have no place pretending to have a mandate. And the reason I bring it up is this chart here, which breaks this is a chart of all of the eligible voters. Those who vote Democrat, those who vote Independent, those who vote Republican, and those who refuse to vote. And the refuse to vote people typically are marginalized or written off as, oh, well, if you don't participate, you can't comment, or, you don't really care because it doesn't affect you. You're insulated from everything. But actually, the no voters will be the equivalent in a parliamentary system, to go back to England for a moment, of a no confidence vote, which is to say, there is nothing that you are presenting here that I can possibly support. And since there is not a no confidence line in the American political system, the only no confidence vote I can express is to not vote. And so this chart becomes interesting because it shows all of the eligible voters in three buckets. And if the no confidence voters had their votes counted, they would have won the majority, would have won all the electoral votes in all the yellow states in this chart.
Which is, by the way, been mostly the norm. Joe Biden in 2020 was the first president to have more votes than didn't vote since, I believe, Clinton in 1992, if I recall correctly. So this goes back to
1896 and the alienation of William Jennings Bryan, but that's for another day. At this point, we're dealing with a no confidence vote and an incoming president, and this would have been true either way, by the way, where more or less 2 out of 3 and maybe 3 out of 4, but I'll be conservative and say 2 out of 3 eligible voters do not want and do not support the incoming president. And so when people say America chose this person, or can you believe the majority of Americans chose this person, that's a false statement. And it's much better to ask yourself what has happened to the American political system, that the two choices that are offered for the most powerful position in the land are these choices. Why are we not getting better choices, and why do we not have a system that has better leadership emerging from it? I know, believe me, I've written books criticizing it, but the question is, what can we do to improve the offering of talent to lead this country? And this is Exhibit A. So the thing that grinds my gears is people saying that everybody wanted either one of these politicians, let alone even including the winner. Because I believe it creates a deliberately false momentum intended to steamroll policies that are popular with a minority, not the majority of the country.
I tend to think that this is where I go deep into my non-markets, pure philosophical sort of bag. I tend to think what this represents, because this is the kind of thing that happens currently everywhere around the major economies, save for maybe Italy.
And Australia, where it's against the law not to vote.
Sure, but I'm saying the level of dissatisfaction with the current political establishment of both left and right is widespread.
Is bigger than the United States. The no confidence vote is a real
is everywhere a thing.
Well, look at Keir Starmer in the UK.
For me, this is a demographic thing.
Yeah.
We are watching baby boomers finally relinquish power, and the generation behind them, the Gen X generation, is very small.
And it's getting skipped over to millennials.
We're finally starting to see that sort of elder millennials, my age and around, are starting to get into positions. And when you start to think about people like, if you want to look on the
JD Vance,
Adam Kinzinger,
never had a Gen X
Pete
president
Buttigieg,
or vice president.
These kinds of
millennial
people.
vice president.
Yeah, so
you don't have to be so happy about that, Vecchio. There's no reason. That's nothing smiley there.
It's as someone who is deep in the meme trench warfare against the other generations, against the Skibbity Sigma folks below me and the Gen Xers above me.
You know who we get along with? The Gen Xers is
the silent generation.
We get along with Gen Z.
That's not good.
That's a dire prediction.
X and Z's, they get to hang out. Nobody knows it. That's a secret hookup right there.
Yeah, well, that's part of the problem in America right now. People aren't doing that, Dylan. Right? Like, go outside and touch. People need to go outside and touch grass and talk to members of the opposite sex in the bar.
Listen, I'm saying the primary vote is no confidence.
Well, we're gonna have to talk about that another time because. Times at a time.
That's what grinds my gears.
We'll be back tomorrow, same time, same place, here on Tasty Live, always after last call, 4 p.m. Eastern, 3 Central. So for Dylan Radigan and Ilya Spivak, I've been Chris Vecchio. Stick around, though. After a brief break, Tasty Live at Night continues. Ilya's back with Macro Money, and it's Tuesday now, which means he's also on with Victor Jones for The Price of Truth. So Indeed. Ilya at Night coming up here on Tasty Live.
It's that time again. Major U.S. economic data hangs in front of markets, and they are reluctant to move until it is out of their way. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live, and we are going to break down what will be probably the biggest piece of fundamental or economic event risk for financial markets this week, the incoming U.S. CPI inflation report. We got a little bit of a preview today with the wholesale inflation number, and that had an interesting response that we'll take a look at here. And then, of course, break down what's on the menu for CPI and what it might do to influence these markets as we try to trace next steps. So first, just take a look at this intraday chart of the S&P 500. This is benchmark ES futures, the active contract. And really all we're looking at here is just how responsive markets were to the wholesale inflation data that we saw today, or alternatively, not very responsive. So this is it right here. Now you can very clearly tell that markets were quiet, they were quiet, they were quiet, and then they weren't. So you can clearly see here that the markets did, in fact, notice the number, respond to the number, and trade on the number, then had a volatile session back and forth, and ultimately landed where the number left them. So very clearly there was a level of response. There was a reaction function. It just didn't last. So why did stocks pop on this data? Well, of course, this is a great illustration of what the markets care about at this juncture. Of course, we saw that last week the markets took quite the beating, over 2% of a drawdown in both the S&P and the Nasdaq last week, and a surge in yields, a steepening of the yield curve. All of that thanks to economic data that made the Fed appear like it would be even less dovish than even the